Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures are wavering after the S&P 500 hit fresh record highs this week, and as a global stock rally that persists right now. China stocks surging today after strong earnings from Alibaba fueled some optimism over artificial intelligence, sending Chinese technology stocks to their highest level since, get this, 2022. In Europe, the Stoxx 600 index is heading for its ninth consecutive weekly gain on the back of resilient profits and optimism over peace talks in Ukraine.
Plus, investors looking ahead to a fresh set of economic data out this morning. The final reading of a University of Michigan's consumer sentiment that will be crossing the wire in just about an hour. The report following a preliminary reading that showed sentiment actually fell to a 7th-month low in early February. That was due to an increased short-term inflation expectations, much of that related to tariff concerns.
And over the weekend, investors will be watching out for Warren Buffett's annual letter to shareholders. The veteran investor known as the Oracle of Omaha will release his letter as well as Berkshire's annual earnings report. With the famed investor's cash piles at record highs, investors will be looking for any clues on his investment outlook after he cut his holdings in Bank of America last quarter and kept his Apple stake intact. Well, good morning. Let's take a look at U.S. stock futures. Right now, mixed. The Dow is down by about 0.5%, but seeing some gains for the S&P 500 and the NASDAQ here this morning after hitting record highs this week. While tariffs and their inflationary impact have been front of mind for investors, Wall Street may not fully be pricing in policy risk from the White House. Here to break it all down, we've got our markets reporter, Josh Schaefer. What more do they need to be considering in that policy risk?
Yeah, Brett, so there's been some interesting growing discussion about, of course, we talk a lot about tariffs because President Trump is talking a lot about tariffs, right? But one thing that has been a little bit underneath the headlines, but is a key part of his policy would be deportation, right? And also limiting immigration into the U.S. And immigration has been a large story of why the U.S. economy outperformed and we didn't go into a recession when a lot of people were calling for a recession over the last couple of years. There's an interesting note from Michael Gapin, the chief economist over at Morgan Stanley, and what he's pointing out is we were having pacing an immigration of about 3 million per year from 2022 to 2024. Assuming Trump's policies go into effect as expected, immigration would fall to 1 million this year, 500,000 next year. Why does all this matter? The key here being if immigration falls to that level, it's going to have impacts on the labor market and potentially impacts on inflation. So it would potentially slow growth, slow GDP to perhaps below 2%, continue to slow growth over the next couple of years, and a key inflationary pressure could come up here, which is something you guys recently talked about with Blake Gwynn from RBC. He was pointing out, okay, if you lower your labor force, there's less workers. What do we know about when there's less workers and less overall supply, right? That means that the actual employers are going to have to potentially offer more money. Then we get wage pressures back. That's an inflation problem. So overall, I think the takeaway perhaps here being Trump policy is not going away as a headwind for investors and something to think about. Just because we get tariff headlines and we maybe eventually get clarity on tariffs in the next month, the ongoing policy cloud, if that's what you're worried about, that is not something that is just going to disappear next month or disappear come March, April.
Yeah, Josh, that's a great point. I guess the question for investors is how quickly this could change and how quickly that would then be reflected in some of the data. Obviously, it'd be real time here, but just in terms of the escalation of that and trying to figure out just how broad or how sweeping of a change we're actually going to see from the White House.
It seems like it would be late 2025 you would start to see this in labor market data, which is kind of similar to what you might see from some of the tariffs too, right? And that's sort of why the current narrative is maybe Fed doesn't cut for the first half of the year, wait and see how some of this plays out, and then they potentially cut in the second half of the year. But it also was, again, to bring it back to the conversation you recently had with the strategist, it was one reason why people brought up hikes, right? If this is as bad as it could be and really does put inflationary pressures, it wouldn't pass through in the same way tariffs would. So tariffs would probably be a one-time pass-through cost, right? Those prices go up and they only go up once. If wages reaccelerate and spiral, that wouldn't be a one-time pass-through. That would be an issue that would perhaps start in late 2025, maybe even carry over into 2026, and it would change the Fed narrative a little bit more than currently anticipated. So then that would change probably how you're investing, right? We would be in a little bit of a higher rate environment, if not maybe a hiking environment. We've talked a lot about the Fed easing bias being a key to this market right now. This is one of the risks that could potentially change that. But again, a lot to be seen when it comes to it.
Yeah, certainly the ramifications are within the economy. All right, Josh, great stuff. Thanks so much. Let's stick with that and talk about the impact that we could actually see on U.S. stocks as a result of some of the policy coming out of Washington. Right now, we have U.S. stocks trading just shy of the record highs from earlier this week. However, though Citi is warning of near-term downside risk to equities, much of that coming from President Trump's policy effects. Joining us now, we want to bring in Citi's head of U.S. equity strategy, Scott Croner. Scott, it's great to talk to you again. Thanks so much for making the time to join us here this morning. So talk to me about that downside risk. What does that look like?
Well, Shauna, I think, the conversation you just had with Josh sets up, I think, a bigger issue. And that is that as we look at where the S&P is trading currently, 25 times trailing roughly, 22 times forward earnings, near an all-time high, the market has been deservedly focused on Trump policies all told, right? Tariffs gets most of the discussion because of its seemingly more direct impact on fundamentals. But the package in its entirety, combination of tariffs, potential for tax reform, which is probably more of a 26 event, then you go down the deregulatory path, which is still, I think, to be defined. But then you have this new element, courtesy of Musk and Doge, where you're now focusing on ways to streamline, make the government process more efficient, which essentially means at some point a potential end to the fiscally positive impulse that we've had in place since the pandemic ended. So our point here is that as you look at the starting point, you look at what probably has yet to be priced in from a fundamental perspective. Our view is that there's still upside for the S&P between now and year end, but between here and there is probably an ongoing period of volatility concern that keeps us looking for pullbacks as better buying points.
Okay, so does that positioning, and as you're kind of laying out all of these different issues that investors are watching for, does that mean you should be more broad market focused to try and hedge some of that volatility, or does that mean you should be in a stock picker's mentality looking for the names that can benefit off of each of these risks that you mentioned?
Well, Brad, the latter for sure, okay? But I think the other element of this, we're talking about macros, and again, the conversation is kind of centered around that. In the meantime, what we're also focused on, which has been written up in our note this week, is that if you look at the Mag 7 component of the market, okay, you're looking at a weight that's, let's call it a third of the S&P index weight. In that case, probably a little bit less sensitive to the broader policy spectrum, probably a little bit less sensitive to the immigration concerns you were talking about. But importantly, on a standalone basis, that part of the market has been showing a decelerating pace of beats and forward guidance raise to expectations. That's an issue. When you're trading at the heady valuation that most of those companies are, our concern becomes that you lose that leadership, which is okay as long as the broadening that we're talking about offsets it. But if you look at the way the years have unfolded so far, you only have one of the Mag 7 actually outperforming. So the broadening is happening, but what I'm saying here is that you need both legs of this to work. You need the broadening effect, which is, I think, a real intrinsic positive for U.S. equity fundamentals, but you also need that Mag 7 to continue to contribute, and that's where we're getting a little bit of pause right now.
Yeah, and Scott, just bringing this back, I guess, to Fed policy, and obviously we have seen this bit of a rotation. There is questions just given the fact that we haven't seen the broader participation from Mag 7, but then coupling that with some of the policy initiatives that you were talking about from Washington earlier this week, where does that leave the Fed, and I guess how tough and how complicated of a decision and another path forward the committee has at this point, trying to determine what is the appropriate and right timing of that next step?
Yeah, so what we've learned from the Fed, they've been, quote, data dependent for years, it seems like, right? So I don't know that the Fed's going to move in anticipation of Trump policy effects. I certainly wouldn't expect that. I think where consensus is currently for a cut or maybe two as the balance of this year unfolds is appropriate. again, we've talked previously about the S&P pricing in soft landing and Goldilocks. Goldilocks gets upset if you move down a path where the Fed is actually in a position to tighten. I don't think that's the case. We don't think as a house view that as a case, but it's certainly a possibility that we have to keep an eye on. But my point here is that if in the background, I'm a little bit more concerned about aggregate consumption, courtesy of Trump policy and some of the immigration and other measures you talk about, I'm incrementally less concerned about the Fed. So we're okay with a 10-year in this 4.5 range, plus or minus. I think where we get a little bit more nervous is if you see rates back up towards the 5 handle. But again, the countervailing force on that is that you're taking a little bit of pressure off of forward expectations on yields, courtesy of some of the initiatives to look at ways to streamline government spending, which really were not in the policy discussion several months ago.
Scott, let's talk a little bit more just about that risk side of that scenario. If we do see the 10-year yield move back up to that 5% level, I guess what would be the trigger of that potentially?
I think it would have to be this. It would have to be, sort of a shock that you're seeing under the surface. Natural inflation pressures tick back in, and then you combine that with the perceived risk of tariffs. Right now, the tariff discussion is important on this because as the discussion has been out there for several months now, many investors quickly go to, oh, this is an inflationary issue, because the expectation is that corporations will essentially take the tariff cost and pass it through in end prices. We question that. I'm not as concerned, honestly, about inflation as I am with the gross margin risk of companies not being able to pass it through and having to kind of take a gross margin hit in turn. So there's a lot of countervailing forces here, Shauna. Very difficult to say how it's specifically going to play out. I think we certainly have to be aware of that tighter for longer Fed narrative. But as we've learned over the past couple of years, a higher Fed, more hawkish Fed policy doesn't have to be necessarily negative for stocks as long as there's a fundamental offset. In the past couple of years, it's been the Mag 7 and the AI push has been that fundamental offset. So, we've got a balancing act here that I think if I'm going to kind of, pull this all together, it kind of comes back to the starting point. What's happening right now in the market, in our view, is that individual stock and industry group activity is where you're seeing the expectations for rates, the expectations for Trump policies to play through. But so far, it hasn't been an all-in index issue.
Scott, thanks so much for taking the time here with us today. Appreciate it.
You bet.
Another asset class we've got our eyes on, safe havens. Gold is heading for an 8th consecutive weekly advance due to robust haven demand fueled by geopolitical and trade tensions. Gold has hit successive records this year after climbing 27% in 2024 amid mounting concerns over President Trump's disruptive trade and geopolitical agendas. The precious metal hit a fresh peak on Thursday amid fears that Trump could unwind American support for Ukraine. Goldman Sachs this week raised its year-end target for the metal to $3,100 an ounce, saying the central bank buying would be a key driver here. Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, a check-in on EVs with Rivian results out and reports Tesla could invest in Nissan. We'll discuss those reports, plus look at where options are pricing in Nvidia's next move with earnings due out in less than a week. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about Rivian this morning, beating fourth quarter expectations and posting its first gross quarterly profit. Still, the electric vehicle maker expects fewer deliveries this year compared to 2024. Joining us now for more on RIVN, we've got Garrett Nelson, who is the CFRA analyst. Garrett, great to have you on the program with us this morning. How are you assessing these results from Rivian and this profitability marker?
Sure. The quarter was a positive. They beat on the bottom line. Was driven by stronger revenue, which came in $300 million above consensus expectations. This was really driven by software and services revenue, which is their agreement, the JV agreement that they recently signed with Volkswagen, which is a very high margin revenue stream. And that enabled them to generate a positive gross margin overall of about 10% during the quarter, which is a milestone, having been negative gross margin for some time. So still didn't help them on the bottom line with a profitability, but was a step in the right direction. Now, the negative was the 2025 guidance. And I think that's much more important. Obviously, what they reported for the quarters in the past, the market is forward looking. The sales guidance that they provided of 46,000 to 51,000 units for the full year actually implies a slight decline from what they sold last year. So I think that's why you're seeing the stock trade down pretty significantly here in the pre-market.
Garrett, what does it tell us a little bit more broadly just about some of that uncertainty stemming from the policies and changes here to incentives?
Well, we think there's a real demand issue here. We've seen EV growth slowing for some time. And, you know, if you're a Rivian and you're producing and selling roughly 50,000 units a year, it is very difficult to compete with a larger automaker such as General Motors or Ford, both of which sold over 2 million vehicles in the U.S. last year. So you think about that, that's over 40 times the volume that Rivian did last year. So, and we're seeing in the marketplace consumers showing a lot of interest in hybrids as opposed to pure battery EVs, which of course Rivian produces. So they're fighting that headwind. And then you have the federal EV tax credit, which we think will be going away later this year when new tax legislation is passed.
You know, elsewhere in the world of EVs, while we have you, Garrett, it seems like there is some type of brouhaha forming, at least in the will they, won't they, in the terms of an investment potentially between Tesla and Nissan. You do have the denial that came out, that is fresh in recent hours as well, that a former board member at Tesla is ultimately kind of pushing back against this FT report here. So all these things considered, what are you anticipating could be the environment for EVs, knowing that you're going to have federal tax credits that get rolled back this year, and then also you have even more of the entrenchment that Tesla is looking to steer forward?
Yeah, no question. It's a difficult environment, especially if you're a small EV startup that maybe went public 3 or 4 years ago. Earlier this week, you saw a bankruptcy filing from Nikola. Last June, you saw Fisker file for bankruptcy. The cash burn rates are just unsustainable for these companies. So it's very difficult. It's a very difficult environment for Rivian, Lucid, and others. As far as the Tesla news, I think this is Nissan would like to do a deal with Tesla. We know that their discussions with Honda reportedly fell through recently. They're in a very difficult spot. They're like a lot of traditional automakers in that they've been losing market share for a long time now, both to Chinese upstart automakers, as well as companies like Tesla, who have grown their volume dramatically over the last few years. So Tesla hasn't indicated any interest in Nissan, but we do think they should take a look at this opportunity. It could make sense for them. A few years ago, they put out a long-term goal of growing their annual volumes to 20 million vehicles sold per year by 2030. That is a very lofty goal. And from our perspective, we just don't understand how they would possibly get there unless they make some acquisitions. Tesla has long showed a preference for greenfields growth, for organic growth, and they haven't done much of the way of acquisitions. The one exception being their Fremont, California factory, which they bought from Toyota in 2010. But this isn't really in their wheelhouse, to do something like this. But we do think it makes sense for them to at least look at everything makes sense at the right price in our view.
Garrett, I think at least from some of the initial reactions that I'm reading this morning, there's just some questions around the synergies, right? And I guess how quickly Tesla would potentially be able to use some of these Nissan factories. From your assessment, what does that look like? Is that a concern?
We think, reportedly, they're shopping their some of their North American plants, and so we do think that makes sense for Tesla. The problem is Tesla really prefers to build from scratch, utilizing the latest in production techniques, robotics, and other methods to really drive down their unit costs and gain a competitive advantage over other automakers. That's what they've done. You've look at the Austin factory, Berlin, Shanghai, the new factory that they're planning to build in Mexico, all greenfields plants. So this would be out of the ordinary for them to buy assets, but we think Nissan is sort of in somewhat of a distressed situation, and we think they could potentially acquire those plants at the right price. So it's something they should look at.
All right, Garrett, great to talk to you. Thanks so much for making the time to join us.
Thank you.
Let's take a look at our second trending ticker here, Yahoo Finance today, and that is UnitedHealth. It's under a bit of pressure here this morning following a report out from the Journal that the Justice Department is investigating the company's Medicare billing practices. Now, when it comes to what the Journal is citing, they're saying that this is a new civil fraud investigation examining UnitedHealthcare's practices for recording diagnoses that trigger extra payments to its Medicare Advantage plans and the patients that come under the Medicare Advantage plans. You're looking at losses right now of just about 11%, nearly a 12% drop here in the pre-market. Now, let's talk a little bit just about the significance of this and this analysis that was done from the Wall Street Journal and why this is so serious and in terms of if this is true, why they would be doing it. Because it actually found that patients examined by UnitedHealth employed doctors had huge increases in lucrative diagnoses after joining the company's Medicare Advantage plans. Why would they do this? Patients that do have certain diagnoses, the payments go up, and that creates an incentive to diagnose more diseases. So that, of course, is what the Journal report is calling out, and that is why you're seeing such a significant reaction here in share prices this morning with the stock off just over 12%.
Yeah, no, spot on. This is something that we've seen administration over administration try to tackle, how the healthcare system has been going after consumers, specifically with some of the phantom billing, with some of the need for consumers to even ask, hey, what am I being billed for here, and get itemized billing so that they can push back on things that get included that don't ultimately need to be listed out or even included within what they're paying for when they go to just make sure that they can get a full Medicare, or not even Medicare, just a medical benefit taken care of in full here. The Department of Justice, they're looking to kind of understand how this company's practices for diagnoses and documenting diagnoses also triggers these extra payments too. So that also part of the Wall Street Journal report, and they're citing people familiar with the matter on this. So we'll continue to see how shares react throughout the rest of today. Finally here, Celsius buying rival energy drink maker Alani Nutrition for $1.8 billion in cash and stock. Alani Nu has positioned itself as a low-calorie fitness aid and has gained popularity through social media influencers. The deal expected to close in the second quarter of this year. Shares of Celsius, they're moving higher by about 34% right now. What they did kind of give in terms of the clarification on this, it sounds like $1.8 billion, $150 million in tax assets for a net purchase price of about $1.65 billion here is what the company is saying as part of this announcement, and combining two growing and scaling brands in the energy drink category here.
Yeah, I think a lot of this has to do with fending off some of that increased competition, and something that analysts have brought up time and time again. Jefferies was out saying that some of the new sugar-free offerings from Red Bull is only going to add to that competitive landscape here in the coming years. Ahead of this report, though, you are looking at a 34% jump here in pre-market. The stock was off about 70% from its peak just about a year ago. So certainly under a tremendous amount of pressure as investors, as analysts try to work through the slowing growth that we certainly we have seen at Celsius. So this is an effort here to regain some of that lost momentum. We will see whether or not that is done. But again, it has posted year-over-year declines in the past 2 quarters when it comes to revenue. It's trying to do all it can to regain some of that lost sale momentum, which has slowed. We'll see whether or not this gets it done. I've never had.
Really?
No, Alani Nu Nutrition. No, I've never had
Alani
it.
Nu.
Yeah.
Okay. Have you had a Celsius?
Yeah.
Oh, my bad.
Of course. It's a staple around here at Yahoo Finance. I feel like someone's always offering one. Says a lot about us. All right, we're going to go to break, but when we come back, we've got the opening bell coming up next. Just about a few seconds here until the opening bell rings on Wall Street as we kick off the final trading day of the week. Let's take a look at where things are set to open. Again, it has been a little bit of a mixed action here in pre-market trading as investors digest more earnings that were out ahead of the bell and after the bell last night. And of course, square that off with some of the policy initiatives coming out of Washington. S&P hitting a record high earlier this week. We did see a bit of a pullback there. But again, when you take a look at where things are opening today here, it looks like we are going to see a bit of a mixed picture as things do calibrate here. You've got the Dow off just about 0.6%. The S&P actually back in negative territory right now, opening up lowered by a fraction. You've also got the NASDAQ, it looks like, under just a bit of pressure today. It's also important to take a close look at the bond market and some of the reaction that we have seen there. We're just below that 4.5 level. Again, a move lower here of just about 1 basis point. But again, good to keep in mind, actually, the NASDAQ opened to higher here. You're looking at gains of just about 0.2%. When you take a look at some of the sector action here this morning, on an intraday basis, you got communication services, consumer discretionary among the leaders here this morning, followed by financials. On the flip side, healthcare is off just about 1%. A lot of that has to do probably with the fall in UnitedHealth. Taking a look at a 5-day chart here, what we have seen here so far this week, you're looking at energy among the gainers for a day because it's actually a holiday shortened week here. But again, energy an outperformer here as of late. You've also got utilities here moving to the upside. Real estate among the outperformers here today. Consumer discretionary lagging behind. Let's kick it over to Jared Blicker with a closer look at some of the movement that we're seeing. Jared.
Yeah, Shauna, thank you. Well, we got to talk about the indices first. And in a bull market, the index volatility shrinks. And so it's supposed to be somewhat boring. I'm going to put on a 4-day chart and we're going to see, well, hopefully, let's try the S&P 500. S&P 500 basically flat on the week. NASDAQ right there with it in positive territory today, but just kind of fluctuating not too far from the unchanged line. So not a lot happening. And yesterday, the NASDAQ and the S&P 500 had their worst day in 2 weeks, but it was not a disaster. It's just kind of reminiscent of the fact that we do have this lower volatility in this bull market. Not a lot happening with the dollar or the 10-year T-note yield, so we're going to move on to the sector action where Shauna was just talking about some of the week's leaders. Energy and healthcare were the leaders coming into yesterday. Healthcare taking a bit of a dip today, as Shauna noted. I do want to point out some of the things happening with the Mag 7. So we're going to look at our leaderboard here, and let's get the MAGS ETF up, and we're going to see that they have been consolidating in a pretty strong pennant formation for a couple of months here. So I'm going to put on a 3-month chart, and hopefully that gives us a picture. Basically, it's going to look like this. We'd have a consolidation, and we're looking for a breakout to the upside or the downside. You're just going to have to take my word on that one. Let's switch over to the NASDAQ 100. This is, again, a 4-day look. So this is what happened this week. Meta having its worst week since December, yet it is still the only Mag 7 name that is appreciably contributing to S&P 500 gains this year. This is a year-long look. You can see Meta up 20%. Really everything else trailing it by quite a large degree. So enough on Meta. I want to tackle Apple, which if it closes in the green today, that will be 8 of 9 days to the upside. And it was only last month that it bounced off the 200-day moving average, which I'm drawing in here. It's just a rough representation, but it bounced off the 200-day, and now it's back up to the decision area. Are the shorts going to reload here, or are they going to get squeezed out? And then it would be a quick trip to highs and maybe even higher from then on, but that's looking pretty far ahead here. Want to also check in on Amazon. Haven't looked at this stock in a while. It was about to snap a 4-day losing streak, but it looks like they're going to add on to it today if they stay in the red. So that's down about 3% this week. And now let's take a look at the chip stocks, because I was looking at the year-to-date, I was looking at the weekly totals here. Supermicro and Microchip, they are leading the S&P 500 this week. So let's see if we can find Microchip or SMCI. There we go. This small square is 4% today. Over the last 4 days, that's 28.76%. And here's a longer-term chart so you can remember where we came from. They were added to the S&P 500 right at the top, saw this significant decline, and now we're bouncing off of these lows here. So that's the story with SMCI. And here's Microchip, 5-year chart, and kind of a similar story there. It wasn't added to the S&P 500 at the same time, but it did see that significant decline, and now it's trying to climb out of that hole. I'm going to close it there because I didn't really see anything notable happening in either futures or Bitcoin. So on that note, Brad, I send it back to you.
That's fair, Jared. You've done so much already. We appreciate it.
Thank you.
Nvidia reports fourth quarter earnings after the closing bell on Wednesday, February 26th. Catalyst co-host Madison Mills joins us now for a look at the 4 things that she's watching. Hey, Maddie.
Hey, Brad, that's right. We're watching supply and demand dynamics, any color on policy impact from export controls to tariffs, and forward guidance, which could include comments on the Blackwell chip and deep-seek competition. So let's break these down. Starting it off with supply versus demand. We've seen Microsoft, Google, and Amazon missing on revenue expectations in part due to lack of supply. They didn't have the capacity to meet strong customer demand. Will the same be true for Nvidia? The street is looking for nearly $40 billion in revenue. That number would be hard for Nvidia to hit if they can't meet customer demand for the quarter. Next up, you're looking at dynamics with China and export controls. The Biden administration had already restricted Nvidia's AI chips from being sold to China. The Trump administration has signaled an interest in furthering those export controls in order to boost domestic chips production, especially after DeepSeek said that they had used Nvidia's chips to train their cheaper AI model. Another policy to watch here, tariffs on chips. President Trump had teased out a potential 25% tariffs on chips this week. That could be a problem for Nvidia because the company obviously dominates in AI, but there are lower cost alternatives. So if tariffs increase the cost of Nvidia chips, they have a choice. Customers, would they pay up or would Nvidia eat those costs? And if they do, that could put pressure on their profit margins. Lastly, we're looking at forward guidance and the success of Blackwell. Investors want to know when Nvidia's next-gen Blackwell chips will take over as the dominant driver of revenue in their data center business, because that could drive guidance higher due to the high cost of Blackwell chips. And that guidance could also include commentary on that DeepSeek competition, that DeepSeek market drop that happened just before the other big tech earnings. Nvidia has had a lot more time to prepare a thesis around that than the other big tech names. So will we get that thesis around DeepSeek? That'll be a big question, and we will see answers to hopefully all of these on February 26th.
All right, thanks so much, Maddie. Let's continue the conversation about Nvidia. Nvidia earnings out Wednesday, February 26th, like Maddie just said. After the bell, options implied volatility signaling potentially a more modest reaction than what we have seen as of late. When you take a look at the fact that maybe now there's questions about how important this is to the overall impact of the market. Joining us now, we want to bring in David Boole. He's the Baycrest Managing Director, Equity Derivatives. David, it's great to talk to you again. So talk to me just about the size of this reaction. What should we be expecting?
Well, like you said, options are expecting about a 7% move, which is a little bit less than what options have expected in previous earnings reports over the last 2 years. And exactly, I'm wondering aloud if this singular report, which used to be a massive focus for the market, just matters a little bit less than it used to. Now, I'm looking back at the last 3 times Nvidia reported earnings. QQQ, the NASDAQ ETF, was about flat that day. If you go back to the end of 2023, early 2024, Qs were up or down 2% 3 out of the 4 times that Nvidia reported those times. Lately, it just hasn't been driving the overall market action as much as it used to. And then specifically for Nvidia, this 7% implied move is a lot. That's like $240 billion of market cap that are expected to be created or destroyed. But Nvidia is such a overall volatile stock that's only about double or 2.5 times as much as it's supposed to move on a normal trading day. So it's a big event, but I'm starting to think that it might not be a one-day surge like it used to if you go back 1.5, 2 years, but it might really set the stage for what the next month is going to look at. So I'm looking at this as a 1 month event, essentially, not really just the one-day jump move this time around.
And so with that in mind, what do you think is the core driver of that move here? Is it demand? Is it ultimately saying, you know what, DeepSeek's not an issue and we're still a beneficiary, even if DeepSeek or other language learning models out there are successful? What is it from your analysis?
To me, the setup, it coincides with what I just said. Maybe it's more of a muted reaction because we already tested the low on this DeepSeek news. We had the dress rehearsal about a month ago or 3 weeks ago, where we saw what happens if the stock goes down 17%. Well, we saw the dip buyers stepped in size. There were some put buyers that came in to hedge those positions, but anybody that was feeling a little bit wishy-washy about potential gains they're sitting on in the Nvidia stock, they had the chance to hit bids on that day that moved lower, and then new buyers stepped in. So the setup I'm seeing from clients is that it's certainly less overowned than it was over the last 2 years. The numbers are likely to be pretty strong, but how good could it be with, the rest of their major customers already reporting big CapEx numbers? I think the sense is, what can they say that's going to really drive Nvidia up another 20% in one day? But if anything, this could be an overhang. Removed, and the stock could then grind higher over the next couple weeks or a month.
So David, what's your trade idea off the back of this?
So as I'm saying, I don't think it's going to be a huge one-day move. Options still have that memory of it moving a ton over the last 2 years in one day. So I like playing for the stock to grind higher. And so the trade that I would put on is a call fly. It sounds fancy, but the point of this trade is to risk a limited amount of premium. I don't want to have an open-ended max loss on this position. So in this specific example, I would buy the March 150, 160, 170 call fly. And so what I'm doing is I'm buying one of the March 150 calls, selling two of the March 160 calls, buying back one of the March 170 calls. The whole idea is play the stock drifting higher. The one-day theta burn of the stock, how much does it cost to carry it, is almost flat. For instance, if you buy a call for $5 or $10, every day that it doesn't surge higher, you're going to lose a little bit of money. But if you structure it where you're buying and selling the same amount of options, then it's not going to decay over time as much. So that gives me time for the stock to drift higher. And then it's about a 50% implied vol stock. So that's expected to move up about 15% per month, which it has last February and March. It's been a very strong seasonal period for Nvidia. So I like to play it grinding higher. And if it does grind higher 15% over the next month, I can still make an explosive return up almost 10 times my money in that period if it pins at 160.
David, I'm curious how you looked at the volatility that we saw just a few weeks ago with the developments of DeepSeek and really the volatility that sparked or triggered across the AI trading spectrum. Put that in perspective for us, just in terms of, I guess, the likelihood, the hedging that maybe investors should be keeping in mind as we do get more and more developments just about how advanced some of this new technology is.
Well, we saw the dip buyer step in the stock, and the whole makeup of the options, which I look at closely, it's investors aren't, the whole narrative that investors were buying calls and that was the tail of the dog wag, pushing the stock higher. That doesn't seem to be the case from the flows that I'm seeing. A lot of investors seem to be long the stock, happily long the stock, and selling calls to extract income and selling puts to extract income. So there's a lot of clients that are betting on the stock to stay somewhat range bound. It's all relative. If Nvidia is bouncing between 120 and 150, that's a big move for any other stock. But for Nvidia, that's still a pretty modest range. And so investors have been selling options, and that helps kind of self-perpetuate the stock staying in a tighter range. We've now had, today might be the fourth, we've now had 3 days in a row. Today could be the fourth where the stock hasn't moved more than 1% in either direction. That hasn't happened since 2023. So anybody that's thinking about hedging the downside, I would also argue for spreads on the downside. Buy a put spread to limit the amount of premium you're spending on an option in case it is a very modest move. And also, in my opinion, we've proven that there are dip buyers that want to step in down at that 120, 115 level. So I would be looking at spreads on both sides, up and down.
David, thank you so much for taking the time. Appreciate it.
Thanks.
We will have special coverage of Nvidia's fourth quarter earnings report Wednesday, February 26th, starting at 4 p.m. Eastern Time on Yahoo Finance. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief.
The U.S. dollar index seeing a 5% rally from President Trump's election up until his inauguration. But since then, the greenback has fallen about 1% as investors ditch America First wagers amid growing trade tensions and inflation concerns. Now there's some growing chatter on Wall Street about a so-called Mar-a-Lago Accord as Trump's nominee to lead the White House Council of Economic Advisors laid out a roadmap for reforming the global trading system and weeding out economic imbalances driven by, quote, persistent dollar overvaluation. Let's talk about this and more. We want to bring in Sandra Martin, the head of monetary policy and FX research at DZ Bank. It's great to have you back here on Yahoo Finance. So talk to me just about what this all spells out here for the dollar and some of that momentum that maybe could be lost or regained here in the weeks to come.
Well, obviously, we've had a really tough month since Trump moved back into the White House. There's been, decrees being signed. It's been, tariffs announced and delayed. And, it's really difficult to look through the very confused messaging we've been getting here. The latest news, obviously, as you just mentioned, the Mar-a-Lago Accord, the idea that, you have a concerted action to prevent the overvaluation of the dollar. At the same time, the U.S. has confirmed that it stands by its strong dollar policy. So again, it's a lot of confusion. And I think when you look at the market reaction, there's been some movement, but I think investors are really, really struggling to see clear headway here because they're trying to figure out, on one side, the possible economic impact of Trump's policies. So we're talking tariffs, we're talking immigration policy, etc. And on the other hand, obviously trying to figure out which things they even should be taken into consideration, because of course, with Trump, you never quite know what you're going to get in the end. So there's a lot of confusion in the market right now. I think there are people who are starting to get more bearish on the US dollar, and I can understand that given what's happening. But I'm not quite ready to throw the towel because I still do believe that tariffs will come, and when they do, they will have a positive impact on the dollar.
What's the reaction that we saw last time? Because in Trump 1.0, we had tariffs, and a lot of economists, a lot of investment strategists were saying going into the election, hey, they can just dust off their tariff playbook from Trump 1.0 and potentially apply that here. So what did we see that first time, and then how much of that can be mirrored or perhaps the same play run this time?
I think it's quite different, to be honest, because first time around, the tariffs came quite late in the presidency. So that's not something he started off with. So there was a couple of years almost that went by until we got the full tariff story. So this time around, it's been an issue from the get-go. The other thing is that we're talking a level of tariffs that is going to be potentially much higher than what we saw during the first presidency. I mean, looking at China, for example, the tariffs have already been increased. We're now 30%. It looks likely that that's going to go up to 40%. That's a lot more than we had first time around. So I think it's difficult to compare those two scenarios. And my general feeling is that Trump is a lot more aggressive this time around. I mean, he's really, setting out a really quick pace here. So I think we have a much more determined Trump to deal with currently. And then also there is the fact that next to tariff policies and domestic policies like, reducing people in the administration, immigration policies, we also have the whole geopolitical context that's going on. So it's much more difficult this time around, I think, for investors to see clearly ahead. And I think 2016 and the years after that isn't a great playbook to sort of mirror from.
Are we seeing too much complacency in the markets, do you think, Sandra?
Yeah, I think so. I think, especially when it comes to tariffs, I think a lot of people presume, Trump, he barks, but he won't bite. And obviously, I can understand how people come to that conclusion because, he made this massive announcement a couple of weeks ago, 25% on all goods from Mexico and Canada. And then that same evening, he basically said, oh, well, let's give it another month and then we see how we go. I can understand how that leads people to the conclusion that nothing is going to happen. I do think that is highly unlikely. I think there will be tariffs. He has this very strong view about trade policy. So I think the market is underestimating and underpricing this risk.
Sandra, we're going to have to leave it there. Thanks so much for taking the time with us. We appreciate it.
Thanks.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief.
Well, I think he's just knee deep in the value trade. I mean, he just does not care about some of the broader things that are happening in AI or what have you. You know, they're looking at staples. They're looking at things that people use every day.
That was Lee Munson, President and Chief Investment Officer of Portfolio Wealth Advisors, talking to us about Warren Buffett's investment strategy and what goes into some of his top bets. Well, there's very few investors that command as much attention as Warren Buffett, if any. So actually, let's take a look at the top 5 holdings in Berkshire Hathaway's portfolio. It's the companies that the Oracle of Omaha has been betting big on. And these 5 companies, they account for about 71% of Berkshire's entire portfolio. So let's break them down. Now, maybe no surprise that Apple is at the top spot there, the number 1 spot there. Now, Buffett has famously called the tech giant, quote, the best business that he knows. It accounts for just 28% of Berkshire's portfolio. And I say just because that's actually down from 50% a year ago. Despite recent selling, Buffett has said that he does remain confident in Apple. At the May's shareholder meeting just about a year ago, he said that it was a better business than 2 of the firm's oldest and largest holdings, American Express and Coca-Cola. Speaking of American Express, that is actually the number 2 holding here for Berkshire Hathaway. Makes up about 17% of the company's portfolio. Now, Buffett's been a longtime believer in the company, first buying shares in the 1960s. Amex CEO Stephen Squeri once told Yahoo Finance, quote, he gets that the Amex brand is special. He tells me that all the time. Next up, Bank of America. Yes, Buffett has trimmed his position by about 1/3 since July, but at 11% of the portfolio, it's no small bet. He first invested in Bank of America back in 2011 when he bought $5 billion worth of its preferred stock. And rounding out the top 5, we've got Coca-Cola and Chevron. Now, Coca-Cola, it's a classic Warren Buffett favorite. It's a stock that he's been betting on now for over 3 decades. And his love for the brand, well, goes well beyond the balance sheet of Coca-Cola. He reportedly drinks up to 5 cans of Cokes a day. It's a true testament to his belief in the product. And at number 5 is Chevron, accounting for about 6% of the company's portfolio. Chevron has been a holding of Buffett's since the 3rd quarter of 2020. Now, the conglomerate currently owns 118 million shares. That's down from a peak of about 170 million back in 2022. Keep it right here on Yahoo Finance. That does it for Morning Brief. Catalyst is up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, we'll break down the outlook for U.S. stocks as investors turn their attention to Europe. Will consumer sentiment change the trade?
Plus, we push ahead to Nvidia's results as the AI chip giant gears up to report. How will Wall Street respond?
And we break down everything Warren Buffett bought and sold last quarter ahead of a big weekend for Berkshire and Buffett.
The final reading of February's University of Michigan consumer sentiment data crossing the wires right now. And you're looking at the number actually falling here, the index falling to 64.7. The estimate was for 67.8. That was the preliminary reading that we did get. The prior month's reading was actually 71.7. So we're looking at a pretty dramatic fall here over the past month. Expectations index falling to 64 flat. That was down from 69.5 the prior month here. When it comes to current economic conditions index, that also declining during the most recent month. Now, the expected change in median prices, this is the real key here to this report, during the next year, that actually rose to 4.3%. We talk about the fact that consumers are a bit more worried about inflation, what exactly the prices are going to be. That was versus 3.3%. It's the highest level that we've seen since November of 2023. The expected change in median prices during the next 5 to 10 years, that actually rose to 3.5%. So, Maddie, that very much is consistent with what we did get in the preliminary reading, just showing that consumers are a little bit more weary and a little bit more worried about what they're seeing in terms of inflation.
Yeah, and it's really interesting to see those inflation expectations ticking up really across the board and not just along those political lines, which is something we had seen post-election. I want to take a look at the market reaction here. All the major averages continuing to be under pressure. We also got that manufacturing data this morning coming in weaker than expected, which also put a little bit of a dent in the market rally we'd seen earlier in the week. You got the S&P down about 0.3%. Your tech-heavy NASDAQ down nearly 0.2%. But let's take a look at what we're seeing when it comes to treasuries. Again, after that weaker manufacturing data, you did see yields coming in, and you're seeing a continuation of that with the 10-year hovering around 4.46 there, down about 4 basis points. Interesting to see that in the context, too, of just the focus that the Trump administration has had on the 10-year yield. We are continuing to see that coming in here off of this weaker than expected data, specifically when it comes to that consumer sentiment data and also the manufacturing data falling quickly. Just want to mention employment falling specifically in that manufacturing data, which could be a negative signal of what's to come in the labor market. We're going to discuss all of this and more with Matt Norton, Raymond James Chief Market Strategist. He is joining us now. Matt, great to have you on. Talk to me about your reaction to the consumer sentiment data and how the market is digesting it as well.
Hey, good morning, Madison. Great to join you. And I think we need to look at all of these surveys with a grain of salt because they change very, very rapidly. And I think there's a number of drivers, especially with respect to the noise that we're getting out of Washington with tariffs. There's also some near-term inflationary pressures with respect to food and egg prices and all of those things that consumers see on a daily basis that I think is really influencing their perceptions of where inflation is going to go and where sentiment is right now. But when you take the bigger picture, and this is something I emphasize to clients, is that the one thing that matters most to the market over the long term is what's happening with earnings. And I think we're forgetting, because of all of the noise that's out there, just how good earnings season has actually been. S&P 500 earnings are up almost 17% year over year, which is significantly higher than expectations. And critically, earnings breadth continues to increase. So you're seeing better earnings across sectors. Financials are the best contributor to earnings growth so far this year, but also down market cap. So areas of this market that I actually like, that I think benefit from the stronger fundamentals underlying this market and economy, or small caps, mid caps, all of those parts of the market I think make a lot of sense to look for on pullbacks that I think are based on some short-term indicators.
Matt, is it going to be enough, though, to offset the underperformance of the Mag 7?
Yeah, and so far it is. I mean, our markets are sitting pretty close to all-time high, Shauna, and I think we lose fact that the Mag 7, even though they're starting to underperform relative to the market, they haven't completely rolled over in totality. There's still certain names in there that make sense. And again, the big takeaway from all of this is that selectivity actually matters again. It matters what you own. You might not want to own all of the Mag 7, but there might be one or two companies in there that still are continuing to do well beating earnings, have good prospects going forward. But there's a lot of areas like financials. Banks have done incredibly well. They benefit from deregulatory trends and the fact that the economy remains in a good shape. Even healthcare, I know there's issues with respect to the DOJ, but you look at medical devices doing quite well. The rest of healthcare today is actually up outside of managed care. So there's a lot of other ways you can diversify your portfolio away from the Mag 7, and the market is holding up because breadth is expanding.
But how much should you be diversifying away from the Mag 7? I get what you're saying about selectivity, but the last 2 years have taught a lot of investors that you can't really afford to not properly allocate to the Mag 7.
Yeah, it's a great point, Madison. And I think people forget too, even if they're just index investors where you own SPY or the Qs or any of the general market ETFs, you own the Mag 7 in a pretty decent weight. So I wouldn't say that the name of the game is underweighting or not owning them. I still think these are fantastic businesses. I mean, when you look for a high quality business, most of those Mag 7 companies are the perfect definition of quality. So I think you still want to own them. But I think what makes sense in this market is when you're looking to perhaps put some of the excess cash that you have on the sidelines to work in the market, or as you rebalance your portfolio and maybe think of just taking the weight slightly down from the winners that you've had in the past and rotating into where the earnings growth are actually going, into places like financials, down market cap into mid caps and small caps, even overseas. There's definitely opportunities internationally to help diversify your portfolio. And you also get a little bit less tech exposure that way too. And banks overseas are doing great as well. The name of the game is balance. How are you as an investor going to build better balance for your portfolios in 2025? Because I think that's how the market is going to unfold.
Matt, how much volatility do you expect Nvidia's earnings to introduce into the market next week?
I mean, the market's expecting significant volatility. We've seen that play out every single time. So all eyes on Wednesday afternoon are going to be on what happens. And it's not even so much the results, it's how good is the guidance. Is guidance going to exceed already high expectations for the market? And that is what's going to determine the price movement going forward. And again, regardless of what happens with Nvidia, I think they're going to still confirm the AI trade is firmly in place. And I think that opens up opportunities as you look to diversify into software. Some of the other AI halo names where earnings are good but got taken down because of DeepSeek, like your data center build out plays. There's going to be opportunities. And so you want to digest any volatility introduced from Nvidia and see where else you might be able to put money building on that theme of balance.
Let's stick with that because, and you mentioned this in your note too, that there are opportunities in AI CapEx beneficiaries. You mentioned their software. Can you get a little more specific for me?
So yeah, I think as you look at where expectations are for results and monetization, software is really the next phase. So it's not necessarily in the big behemoths of software, but when you look down to smaller, maybe smaller, large companies, mid companies, cybersecurity is top of mind. When you look at an environment that we have right now with more and more threats, more and more cyber threats, when I talk to CTOs of companies, a big line item of spending that's actually remained pretty steady over the past few years and actually starting to increase right now is on cyber defense and leveraging AI solutions within cybersecurity. So you want to own some of the cyber companies that are levered towards the best and more differentiated AI plays or AI integration. And so those names have been doing well for a very good reason. So that's one good place to continue to look or lean into as this market continues to be a little bit choppy in the near term.
Matt, real quick, let's talk a little bit about the Fed. I guess, is from your view, is the Fed in a good spot right now? Is there a risk potentially of waiting too long to act again?
Yeah, Shauna, everyone loves to be, I think, an armchair economist with respect to what the Fed should or shouldn't do or what they did wrong or didn't do wrong. I think the Fed's in a fine place. The Fed has set themselves up to wait and see, and that's the exact right approach, at least I think. The economy continues to be robust. There are some cracks that are starting to form, nothing that's opening up into fissures. There's inflationary pressures, but it's all so far in the short term. So we've got to wait and see where the data comes. And I think the Fed has been very proactive in giving that message to the market, which is perhaps why once we made adjustments earlier this year with respect to rate cut expectations, we've seen the 10-year pull back. And I actually encourage clients, if you get the 10-year yield above 4.85, nearing 5%, that's the time to think about adding duration, because I don't think rate hikes are on the table. And I think the Fed's in a very good place to just wait and see how things unfold.
I want to end by talking to you about the Europe trade, which has gotten a lot of attention this week. And you noted that the growth rate for U.S. earnings was around 9%, only about 6.5% for Europe. So how should investors be thinking about the opportunity in Europe when you aren't getting paid as much to sit in European equities?
Yeah, that's a really good point. And I think when you look at diversifying into Europe, especially after the big run that European equities have had over the past, call it 3 months or so, I think you want to wait for a pullback to put some money to work. But you can be opportunistic. The name of the game is selectivity, because not every part of the European market is moving up in tandem. So you want to be careful of what sectors, call it your industrials, material companies, might be more levered to tariffs or to challenges that might come up with respect to China. And instead lean into trends that you know are going to be important. Ceasefire in Ukraine. Whether or not that happens, we know countries have to spend more on defense. So there's a reason why European defense companies' earnings have been good. Lean into that. Banks are doing better because the economy looks like it may have bottomed, and you're seeing good earnings come back. So again, it's always follow the earnings as you're looking overseas and wait for pullbacks. There's no need to chase this market higher.
All right, Matt Orton, great to talk to you. Thanks so much.
Thank you.
Let's do a check on the markets here, just about 41 minutes into the trading day. And again, you're looking at losses here, a bit of a pullback from those record highs that we saw earlier this week. And now you're looking at the S&P dropping once again here this morning, off nearly 0.3%. The reading that we just got out at the top of the hour, University of Michigan's Consumer Sentiment Index falling further here. Lots of concern and questions here from consumers about inflation expectations, those rising sharply, consistent with what we saw in the prelim report. But again, that's adding maybe to that negative sentiment out there on the street this morning. Flipping over to the bond market as well, when you take a look at the 10-year yield, dropping just a bit here, off 4 basis points to 4.46, Maddie.
And before we go to break, just want to level set. Take a look at where strategists expect the S&P 500 to close out for the year in the context of where we are at right now, hovering around the 6,100 level for the S&P 500. The average price target for the street is 65.70. We got a street high of 7,100 and a low of 5,500. That average price target implies just a 7.7% move to the upside from where we currently are. That obviously pales in comparison to those double-digit upside moves that we've all grown accustomed to in the last 2 years. So it'll be interesting to see what that 7.5% move potentially looks like and why we don't see broader gains if that does end up being the case for this year. And just to run through a couple of the big bank calls, Oppenheimer has your street high, 7,100. A lot of big banks at 6,500. That's Goldman, Citi, JP Morgan, and Morgan Stanley. And then you got a lone bear calling for the mid 5,000s. We will call it 5,500. We'll have more catalysts for you right after the break.
The University of Michigan's Consumer Sentiment Index falling sharply in February amid a jump in inflation expectations, the biggest jump that we've seen since 2021. Joining us now, we want to bring in Joanne Shu. She's University of Michigan's Director of Surveys of Consumers. Joanne, it's great to have you here on Yahoo Finance. Talk to me about this massive uptick that we're seeing in inflation expectations and what this signals just in terms of what the months and years ahead could potentially look like.
What we're seeing is a very broad-based conclusion or opinion among consumers that inflation is going to pick up in the year ahead as well as the next 5 years. It was a pretty large month-over-month increase for both short and long-run expectations. It's not necessarily cause for panic at this moment, but these expectations are clearly being driven by concerns over policy, concerns that tariffs are going to lead to price hikes. And it's very anticipatory on the basis of consumers.
How is that playing out across political orientations? We saw after the results of the election a direct flip where Democrats' inflation expectations rose, Republican inflation expectations moved in the opposite direction, indicating similar sentiment to the election results going in either party's direction. What is that sentiment telling you?
Partisan differences in sentiment and in views of the economy are longstanding. So what we saw following the election was exactly what we expected. And that's one of the reasons why it is absolutely critical to look at independents. So independents don't really have a break around the election, and they're usually generally right around the national average. And critically, what we saw this month was that independents had a decline in sentiment as well as Democrats. And they also saw the big hikes in inflation expectations. So the changes that we saw this month relative to January, they're not just being driven by Democrats. We see it critically among independents.
Joanne, is this a trend just from who you have spoken to and obviously comparing it back to prior readings? Is this a trend that you expect to continue?
The trend, if you're talking about the fact that people tend to have higher levels of sentiment when their party is in power in the White House, yes, we do expect that to continue. It's been that case at least since the Reagan administration.
Joanne, more so the inflation expectations, and just given the uncertainty out of Washington and kind of the whipsaw action that we've seen headline-driven wise, how is that potentially? Do you see that being factored in here as we look to the future?
Sure. So the last time we saw such a large increase in inflation expectations, long-run inflation expectations, was in 2008. But times were very different at that time. Inflation expectations then were really reacting to oil price shocks that hit all-time historic highs in June. And then they waned right after that. They plummeted right after that, and so did inflation expectations. This time it's completely different. People are not reacting to current price shocks. They're reacting to anticipated price shocks. And so it really remains to be seen if these inflation expectations will stick. It really depends on what kind of tariff policies are rolled out and whether or not that trickles down to consumer prices.
Joanne, obviously you can give us great insight into this survey, but you're also an economist in your own right. So I wonder if you can put this survey into context for us. How does something like consumer sentiment, inflation expectations impact the real world economy, especially in the context of the last few years where inflation expectations have been rising, like you said, but consumers have continued to be relentless in their spending regardless?
I think what we should know when we look at consumer spending is that consumers have been supported by strong incomes over the last few years, in spite of all the other things that are weighing down their views of the economy. And the other thing is that sentiment hit an all-time low in June of 2022. And since then, it was more or less on an upward trajectory. And that's consistent with the strong spending that we were seeing. People were seeing that inflation was slowing. They weren't feeling great about the economy, but they were feeling better about it than they were in June. Right now, we're in a situation where sentiment is starting to decline and consumer expectations over the economy are deteriorating on a number of dimensions. So the upward trend that we had been seeing between 2022 and 2024, it's not looking right now like it's necessarily going to continue. But again, it's been 2 months of declines. It's really too soon to tell if this decline is going to be persistent to the long term or not.
All right, Joanne Shu, great to get your insight. Thanks so much for joining us here today.
Thank you.
Now let's get to some of today's top trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. Do that Yahoo Finance's trending tickers page. First up, let's take a look at Coinbase announcing the SEC, Securities and Exchange Commission, will be dropping its case against the cryptocurrency exchange. The SEC originally brought a case against Coinbase back in 2023 under then chair Gary Gensler, arguing that certain crypto assets were subject to existing security laws. Now, in a statement, Coinbase is saying, quote, "It is critical that we pass legislation which provides the long-term certainty needed for the U.S. to lead in this industry," end quote. Again, that has very much been sentiment that we've heard from a number of investors, and we've heard from a number of others that are involved within the crypto space, just in terms of the need for clarity and transparency here moving forward. But again, this done under the Trump administration, very much crypto has been looked at as a huge beneficiary under the Trump administration, and what that lighter regulation overall is going to look like, and the fact that they are expected here to further prioritize or put more of a priority on crypto adoption.
Yeah, it's certainly a bullish signal for those crypto bulls out there who thought that this administration was going to be friendlier to the digital currency. And sure enough, we get a decision like this. We should note that this still requires a commission vote, so it's all but official at this point. But this had been essentially a move from the SEC to regulate the company as its own stock exchange. And as early as last week in Coinbase's earnings, they had this shift away from having their own crypto assets be part of their balance sheet. They moved that off, so it looked like they had this huge drop in revenue on their balance sheet, but really they just indicated this shift away from the fact that they own those assets, making it more clear that the consumers own those assets. That's more similar to what you see brokerage accounts doing on their balance sheets. So it was interesting to see that in the context of this decision today, that they are already kind of moving in this direction. But I think it points to the lack of clarity that we have about regulatory pressure on these asset classes and what that is going to look like in the future, though this is certainly a signal of the SEC under this administration potentially being kinder to crypto more broadly. Next up, Meta is approving an increase in executive bonuses following staff cuts of about 5% or 3,600 workers. That's according to an FCC filing. The tech giant raising its target bonus percentage for certain executives from 75% of their base salary to 200% of their base. That'll begin this year. The filing did not include Meta CEO Mark Zuckerberg, and this comes as the Financial Times reports that Meta is reportedly cutting stock options for staff by about 10%. And again, after those layoffs earlier this year, a very small proportion of the staff, about 5%. And David Kelly from JP Morgan talked about this idea that you see a lot of the big tech firms instituting layoffs in the beginning of the year, perhaps around the time of year that people are having conversations about raises. You can kind of prevent the rest of the staff from increasing their raises and their salaries by instituting layoffs and inciting concern about the company's financial well-being, and that is partially why we do tend to get a lot of layoff news early in the year, but it's certainly interesting context when you are announcing increased bonuses to executive staff after cost cuts for the rest of the group.
It is. But I also think you could justify, right, when you take a look at the outperformance of Meta and how far and how fast that stock has come here over the last 12 months. And even since the start of the year, we talk about the fact that much of the Mag 7 has been losing its momentum. But when you take a look at Meta and the contribution that it has made here to the S&P's gains since the start of the year, it has been able to keep up some of that excitement. So again, when you take a look at the higher payouts, especially on the back of such a massive year here for the company, of course, that then helps them justify that. Over the last month alone, you're looking at gains of just about 13%. But again, going back just a little bit longer there, you'll really see the staggering gains that we've seen over the last year. As I pull this up here, you're looking at gains of just about, 49%. 5 years, you're looking at significant gains. Year to date, you're looking just around 20%.
Yes.
Finally, let's take a look at Alibaba adding to yesterday's gains. It's up once again today, following bets that its AI moves are paying off. Now, the move higher today also coming on the back of a journal report yesterday that GameStop CEO Ryan Cohen increased his personal stake in Alibaba. Now it's worth about $1 billion. You're looking at a move higher of about 6% here today. Alibaba is also reportedly eyeing an investment in fellow Chinese company DeepSeek, which promised in a post on X that it will be revealing 5 open source code repositories there coming up next week. But again, the big takeaway is this AI investment and really what the AI focus and what that has done to reignite some of that lost excitement surrounding Chinese tech giants, surrounding their advancement and their ability to compete with some of the larger players here in the U.S. We certainly saw the reaction to Alibaba's results yesterday. It's carrying over once again in today's trading action as well.
Yeah, I mean, it makes sense given the bullish action that we've seen in Chinese tech, specifically all of those CEOs, including Jack Ma, meeting with Premier Xi Jinping earlier this week, indicating a bullish sentiment around tech stocks in China. More broadly, you can see the huge run in Baba stock over the last 5 days. But I do want to zero in on DeepSeek promising to share their open source AI code, because that's something that OpenAI was doing in the beginning and that DeepSeek was able to train itself on. So I wonder if we're sort of going to get into this meta moment where we see the DeepSeekification of DeepSeek's own AI source code moving forward, and if that is going to lead to even more affordable AI models if they can iterate off of what DeepSeek already has, utilizing their open source code that they are potentially going to be pursuing here. That could be a boon for other AI names that want to train themselves off of DeepSeek's open source as well.
After years of the Mag 7 driving market gains, there's finally some broader participation playing out in the markets this year. The majority of the tech cohort taking a back seat. So who's leading the gains? Let's ask our very own Jared Blickery, markets and data editor, also host of Stocks in Translation. Jared, take it away.
Thank you, Shauna. I got a really big number for you, $55 trillion. That is the total size of the S&P 500 market cap. What's market cap? It's total shares of a company multiplied by its stock price. You add all that up and you get $55 trillion, and that is up $2.2 trillion from the end of last year. And here's how it breaks down sector-wise. There are 5 sectors here, and you can see we actually have 6 more on this page. They're quite a bit different here, but I'll go through them and just tell you the biggest one, which we're gonna take a look at today in depth, is financials. That's up over $537 billion. So basically 1/4 of all those S&P 500 gains have been concentrated in the financial sector. And we talk a lot about tech and some of the tech-related fields, but we have seen this broad participation. We've seen other sectors like materials step up, like healthcare step up. Now, healthcare is number 4 here. It's up $317 billion. And if you're wondering what these little white squares are, those correspond to the y-axis on the right, and that tells you how much the sector is up year to date. So financials are up roughly about 6%, and that's actually kind of middle of the pack for them. Energy, and I'm going to show you our other screen here, energy is number 1. That's up 8%, but as you can see, it's only a $96 billion gaining sector this year. It's much, much smaller than financials and healthcare and some of those others we were looking at. Industrials, that's also in the middle of the pack. That's up $205 billion. And another standout here is consumer discretionary. Now, that is a huge sector market cap-wise, but it's basically flat this year. It's only up $25 billion and has a flat return. And why is that? That's a Tesla story. So they also have Amazon in there, and Amazon, I believe, has been gaining, but the Mag 7 have just not been contributing a lot outside of Meta. One more note here before I move on. Meta is part of communication services. I was talking about that earlier. In 3rd place here in terms of market cap gains, and number 2 in terms of return. That has Meta and Alphabet, and that has just been a huge story recently, even though Meta just came off and had a couple of bad days. Now, here is the financials. So here's the financials sector and how it breaks down into industry groups, because there's a hierarchy that we can explore here. So we oftentimes think of banks as the financial sector. That's Citigroup, that's JP Morgan, Goldman Sachs. In fact, those are the biggest members, and so they get a lot of the press. They are up $192 billion this year. Financial services, we have those as well. Capital markets, those are some of the exchanges like NASDAQ and ICE, which owns the New York Stock Exchange, as well as some of the service companies like S&P Global, for instance, and Moody's. Then we have insurance. Insurance is a big part of it. A lot of times it gets overlooked, but that is a huge financial component that depends on interest rates and their structure, similar to how banks perform. And then consumer finance as well, although you can see that's the smallest. So let's take a look inside a heat map, and I have all of the individual companies, about 70 plus within the financial sector, and let's do a year-to-date total so we can see what's going on. What you're going to notice is, and this might take a minute because we got a lot of tickers in here. There we go. You're not going to see a lot of high flyers. If I sort by performance, the highest flying member, that's Citigroup. That's one of the big banks. That is up 16%. And that doesn't compare to some of the high double-digit gains we're seeing in some of the flashier parts of the market. But financials tend to be a lot steadier. And when we have a business cycle, the way we are in right now with the Fed lowering rates and an expected growth of the economy without a recession, that is an environment in which financials can thrive. And here is the biggest one. In the upper left, we have a mega cap. It's $1 trillion company. That's Berkshire Hathaway. And while it's not classified as an insurance company, it's somewhat of a conglomerate. It is definitely the biggest among this group. Then second, we have JP Morgan. That's up 12% this year. MasterCard and Visa, those used to be classified as tech companies in the GIC standard, but those are now financial, so you see those there. If I sort by performance again, you're going to see a definite bifurcation of winners and losers. The biggest loser here is MarketAxess. That's down 17%. That's like a bond market or credit exchange. But some other notable names. We have PayPal, that's down 11%. Private equity names like KKR or Apollo Global, our parent company, and some others, those are in the red. And again, the highest line here, which has some of the best returns, those tend to be some of the bigger banks. And with those, I would also throw in PGR, that's Progressive, that's up 11.8%. BlackRock is up 14%. So the list goes on. But I think if you take a look at the sector action year to date, I'm going to close on this. You're going to see financials have kind of surprised, and along with some of the other offerings that we have, and there's financials kind of the middle of the pack as we were talking about. Not the high-flying communication services, up 8%, home to Meta and Alphabet, but there's a lot of green in this space, and there's a lot to choose from. And I think that's the bottom line. Finally, in 2025, we have a lot of choices in the market which are doing well. Back to you guys.
All right, Jared, thank you so much, as always. Coming up, Nvidia's fourth quarter results on deck, what our next guest says the company needs to do to remain a core holding. You're watching Catalysts.
Nvidia is set to report fourth quarter results next week. Now, this will be the first report since the company officially started shipping its new Blackwell chips. Joining us now, we want to bring in Francisco Obito. He's FM Investments Senior Portfolio Manager. Francisco, it's great to have you ahead of these highly anticipated results that we'll be getting from Nvidia next week. I'm curious, what's the number one thing you'll be watching for?
Well, thanks for having me. I'll be paying lots of attention to the demand for the new Blackwell chips. That's one thing. And I'm also interested in and see if they're willing to discuss how foreign governments of the U.S. government is going to increase their spending in AI, if they have any hints how that's going.
Do you anticipate that commentary being clouded by the DeepSeek of it all? I've wondered, because DeepSeek happened so close to some of the other big tech earnings, if Nvidia might have had a little bit more time to cook on a thesis in response to DeepSeek.
Well, it's not so much about DeepSeek, I believe, in my opinion. DeepSeek is basically a good thing for the AI industry. It's a way of making it widely available to many other potential users. And if anything, it just widens the ecosystem and accelerates the early adoption of AI. So it's a good thing. And I think what people fail to understand is that this is actually a good thing for NVIDIA as well, because the models are not done when you train them. You really got to refine them afterwards. There's post-training that happens afterwards, and you still need the big chips.
Francisco, what do you think the volatility is going to potentially look like?
It's going to be pretty wicked this year. And the reason for that is that it's not only, the normal market volatility. You got to add about the uncertainty brought in by maybe tariff policies and those things, and some of that can be pretty disruptive. So we'll see where that goes. And at the very least, I'm expecting some volatility to come out of it.
I mean, it can be disruptive, but we don't have a lot of clarity on those tariffs. Like right now, the only tariffs that are actually in place is the 10% one on China and the 25% on steel and aluminum. Obviously, the deadlines are upcoming for the others, including sector-specific ones like chips. But how much can the market really react to that known unknown at this point?
Well, it's not so much whether they get implemented or not. It's just the threat of having them. That forces the people on the other side, or the countries on the other side, to think about the diversification, regardless of whether they get implemented or not. So the impact is there, and the uncertainty that it creates is there already. It doesn't have to wait until they're implemented.
All right. Sorry, Francisco, real quick, but my apologies. Before we do let you go, we also wanted to quickly discuss Meta with you, because there's been lots of questions about, after the massive run-up that we've seen, the record days in a row of gains, whether or not we could see a stock split. Do you think that's likely? And I guess how big of a catalyst, if we do in fact see one, could that potentially be for those future moves?
Well, I think, a stock split, it's in the cards. We couldn't discard that. Can we bank on it? Absolutely not. But, it's definitely there. Meta's going to continue to do well. It's going to continue to outperform as we go forward. It's just like, in my opinion, it's just a very solid business, and it's not yet fully monetized. I mentioned that in the past in prior interviews. And the reason for that is that I think they have many places they can poke for earnings, for organic earnings. So they haven't really addressed that yet.
All right, Francisco, thanks for joining us. Appreciate it.
Thank you.
Coming up, we're taking a look at the state of the consumer, specifically when it comes to retail. That's next, right here on Catalysts. Uncertainty about the state of the consumer and the potential impact of tariffs starting to weigh on retailers. Walmart reported strong fourth quarter results this week, but the big box retailer warns of slowing sales this year. Meantime, consumer sentiment data out today showing a sharp drop as consumer inflation expectations rise. Joining us now, we've got Stephen Yalof, Tanger CEO. Stephen, great to have you in studio with us. I just want to start on the state of the consumer. What are you seeing?
Well, first of all, thanks for having me on. Well, with regard to the consumer, I think the consumer was very present and showed a great resilience during the fourth quarter. So our holiday sales, our holiday traffic were up. And, I think in both, we have a outlet platform and we also have a full price sort of town center platform that we're starting to grow. And the customer was definitely out and shopping in both of those categories.
Stephen, I'm curious when you take a look at, and I bring this up because of the consumer sentiment numbers that we got out this morning, this expectation for inflation to rise. Is that good news to a degree, or give you at least some sort of advantage over some of your peers, especially in the outlet division, when inflation is such a concern, or what does that mean for your business?
I think the outlet business definitely benefits during any sort of macroeconomic headwind because the customer is looking for value. And, when you can get, and the beautiful thing about the outlet center business, it's your favorite brands, but every day on sale. So if there's a consumer that's looking for an entry-level price point into one of their favorite brands, whether it's a luxury brand or sort of a middle brand, even Nike, it gives them the opportunity to buy the product they want at the best possible price every single day. And I think consumers really like that. They gravitate to that.
Over the, let's just say, past 4 years, how has the demo of your consumer changed? And I ask in the context of those Walmart earnings, because that's traditionally a lower income consumer that we're seeing struggling so much that they're struggling to even shop at a Walmart. We see that come up in McDonald's earnings, for example. Is the luxury outlet consumer more middle income or upper income?
Well, I think our consumer is looking for branded value. So they're not looking for commodity, meaning, sneakers at the cheapest price. They want Nikes at a great value price. So, our consumer going in is one who understands brand, and I think that that's critically important. On the higher end, I think that there's customers who may not need the latest product in the store, but want the product that they love, the brand that they love, the quality of fabrication. So in some of our stores, whether it's a Tory Burch, a Coach, a Michael Kors, or Ralph Lauren, customer can shop and buy actual product in those stores that at obviously a value price, but give them the opportunity to get that quality that they're looking for.
Stephen, what does the foot traffic levels look like?
Yeah, our foot traffic has been great. And you asked about the demographic of the customer before, but so let me relate that to foot traffic. We've done a really good job of bringing in brands that draw a younger consumer. The health and beauty category is really the category that the younger consumer is looking for right now. You see as many people from 5 to 15 shopping in Sephora and Ulta as you do, older people in those stores. And as those stores
That's for those parents.
And as those stores start to come into our platform, we're seeing a much younger customer. Yeah. And so now we're sort of catering to that younger customer because they're the customer of the future. Right. So we want to make sure that when they come and visit us, there's plenty of things for them to do, whether it's a better restaurant, whether it's better entertainment, experiential things, better amenities. They love loyalty programs to get rewarded for the things that they buy. We've got a great loyalty program. And then, of course, the stores that they love when they come and visit us, that's the most important part.
How are you strategically thinking about that shift in the context of also wanting to keep the older demographic of customers happy and returning as well?
Well, sure. You never want to alienate your core customer. And as some of the brands that they've gotten used to over time start to lose a little bit of market share, there's still an opportunity for them in the platform. But what we're finding is that that older consumers also, their tastes are shifting as well. Yeah. Now, there's been brands that have been in the outlet business for over 50 years. You look at Ralph and some of the other brands I just rattled off before. But I think there's a lot of newness that we're bringing in. Things like American Eagle and Aerie, their brands. Abercrombie doing an unbelievable job right now. J. Crew, brand that's been around for a really long time. But again, they're going after, they got that core customer, but they're also going after a younger customer too. So it's great to see, in our space, all age groups come together and have the opportunity to shop the same stores.
Stephen, I'm curious for your business, when you step back and take a look at the macro environment right now, specifically the Fed, there's risk here that we could be in this high for longer rate environment. what is that ultimately the implications there for your business?
Well, for us, obviously, we're in a very acquisitive state right now. So we just purchased 2 shopping centers in the last 4 months. And, buying shopping centers is how we're going to grow our business right now. Development, there's not a lot of new development happening in the retail space, primarily because the cost of building right now and the cost of land is so expensive. But you can buy shopping centers, particularly those that have come on the market, where we think we can add value. The pricing has been very advantageous for us. We've got a great balance sheet. My chairman likes to say we have a fortress balance sheet. We trade about 5 times debt to EBITDA, which is pretty low and gives us a great availability of capital, so we can go out and we can buy. Interest rates, as they trade up, they certainly will make the cost of debt that much more expensive and obviously challenge a lot of the pricing. But again, for us, we look at going in yields. The last 2 acquisitions that we made were both in that 8% going in yield. But we think that we can also add a lot of value through our leasing, our marketing, and our operations over time.
On the policy front, there's also the potential impact of President Trump's tariff policies. What is the right strategic approach? Is it stockpiling ahead of potential tariffs, or is there a risk to that when it comes to inventory as well? How are you thinking of it?
Yeah, we've been thinking about that a lot, and actually we've been speaking to a lot of retailers and asking them what their strategy is, because it really relates more to the retailers than it does to us. But obviously you can't sell the products if they're not in the stores. What the retailers have said is that they've done a really good job of diversifying away from any one geography where they're manufacturing or supply chain. A lot of that work actually started post-COVID because there was a lot of issues getting things out of certain countries right after COVID. So a lot of retailers did a really good job diversifying their sourcing. And I think a lot of that diversification is still happening. I think the retailers that haven't done a good job with it, they'll probably suffer a little bit more. But fortunately for us, our largest retailers in our platform, those are the ones that I feel really good about their ability to not only source inventory, but fill the stores, which is ultimately what the customers are looking for.
Stephen, always great to have you. Thanks so much for stopping by after
me.
earnings.
I appreciate it.
Keep right here on Yahoo Finance. We got much more coming up next. You're watching Catalyst. Warren Buffett's cash pile has hit record levels as the Oracle of Omaha trims some of his oldest bets and also makes a surprising new one. Let's take a look at some of the changes made to Berkshire's portfolio this past quarter. First up, Constellation Brands. Now, it is a brand new play for Berkshire. The company is scooping up a $1.2 billion stake that makes it the company's sixth largest shareholder of the beer and liquor giant. And this is a classic Buffett value play, the stock trading at just 10 times earnings, its lowest in more than a decade. And Buffett's buying, well, it did not stop there. He also added to his positions in Dominos, in Occidental, Pool Corp, SiriusXM, as well as Verizon. But it wasn't all buying. Buffett did raise some cash during the quarter. He scaled back his exposure. Some of the big banks, including Bank of America, Capital One, and also Citigroup. Citigroup was actually the largest cut of the quarter for Berkshire Hathaway. They reduced their stake by more than 70%. He also trimmed some of his holdings in Charter Communications, in T-Mobile, Louisiana Pacific, and New Holdings. And Berkshire did fully exit one of their positions, and that is Ulta Beauty, selling out completely after a very short-lived investment. Maddie?
Warren Buffett is a new fan of Domino's Pizza. Berkshire Hathaway first started buying shares of the company in the third quarter of 2024, scooping up more in Q4, bringing the stake to nearly 2.4 million shares. Now the pizza chain is reporting earnings on Monday before the open, so our very own Brooke DePalma is here with what investors can expect. Brooke, walk us through your anticipation.
Yeah, good morning. Well, certainly got a nod from the Oracle of Omaha this past quarter, Domino's Pizza, that is, in Q3. Berkshire Hathaway bought in 1.28 million shares, and then in Q4 they added an additional 1.1 million shares, bringing that stake to 2.38 million. And now that makes Berkshire Hathaway the fourth largest shareholder of Domino's Pizza, ahead of this Monday Q4 as well as the full year print. Now, Wall Street expects that this fourth quarter will be a softer quarter here because of that bad weather. Citi analyst John Tower said that investors have already, or shares rather, have already baked that in, and they've sort of moved past that. Now they're really focused on three key areas. That includes challenges around their international growth. We know that their largest global franchisee, Domino's Pizza Enterprises, shared plans to close more than 200 unprofitable locations, with a majority in Japan. But on the upside, two long-term growth drivers that has Wall Street really excited here includes a partnership with DoorDash, the third-party delivery service. We know that in Q1, their exclusivity with Uber ends. We also know that third-party tends to be a higher income audience, so that is a boost to sales as well. And innovation here that also has the street really excited, guys. Innovation around stuffed crust pizza that could come by the end of this year, and that's one sales driver that has Wall Street really excited as well.
Brooke, how has Domino's been able to navigate the inflation side of the picture?
Yeah, well, certainly that's something that we've discussed with them. They have this sort of upside here because they're able to play as a value player, and they're able to sort of offset those costs. They aren't really exposed to things that others are perhaps highly exposed to, like those eggs, like ground beef, like sugar. And so they've been able to navigate that, but also play in as a key value player within the space, and then they've been able to prove up against others like Papa John's, who maybe aren't winning in that space, or able to offer as competitive a value here.
All right, Brooke, we got to leave it there. Thank you so much for joining us. We really appreciate it, as always. Let's get a check on the markets before we wrap up our coverage here today. If I can take a look at the major averages, you will likely see stocks moving to the downside here. We have the S&P 500, I believe, still holding on to a little bit of a lead above the tech-heavy NASDAQ. There we go. So the S&P 500, like I was saying, down about 0.6%, tech-heavy NASDAQ leading the losses today, down about 0.8%. If we can flip the board over to Treasuries, I'll be able to show you that yields are still coming in. Your 10-year still down about 4 basis points. That's really interesting in the context of that data showing inflation expectations ticking up higher. You would think that that could lead to a lift in yields as expectations for a higher for longer Fed to fight inflation come in here, but we're seeing those yields still coming in. One analyst on the street pointing out that could lead to questions about whether stagflationary concerns are hitting Wall Street amid those tariffs that could lead to a little bit of a growth shock moving forward, something that we have continued to cover on the show and will continue to discuss moving forward here.
Yeah, certainly it looks like some of that econ data that we got out this morning, consumer sentiment, adding to some of that, I guess, wariness or concerns out there on the street. And then, of course, when you take a look inside the Dow, UnitedHealth, the biggest dragger there, that, of course, on the heels of the report that we're getting out that the U.S. Justice Department is investigating some of its Medicare billing practices. Keep right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned. Have a good weekend.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks are falling following another dip in consumer sentiment data. UnitedHealth shares are also sliding, weighing on the Dow on reports the Justice Department is investigating its Medicare Advantage business. United has responded to the report saying, quote, any suggestion that our practices are fraudulent is outrageous and false. Meantime, Coinbase shares are higher on news the SEC is dropping its lawsuit against the U.S.'s largest crypto company. The regulator first sued Coinbase in 2023, claiming it was operating an unregistered securities exchange and failed to properly register its crypto staking program. And Celsius shares surging after the energy drink company announced it's acquiring competitor Alani Nu. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, portfolio check-in. I'll talk to one portfolio manager who says investors need to, quote, bring an umbrella for 2025. We'll explain what that means. And the wealth of Nvidia CEO Jensen Huang. Ahead of the chipmaker's earnings next week, we're explaining how much the company's top leader is worth. Plus, with news of layoffs at the IRS, we're asking a tax professional how fewer employees could impact the current tax season and your tax refund. We've got all that and much more coming up during today's show. But first, we take a look at some of the action. We're 90 minutes into the trading day. We are down fractionally across the board for the U.S. major averages as stocks are falling to end a volatile week after weaker than expected consumer sentiment data. Joining me now, we've got Keith Gangle, who is the Gradient Investments portfolio manager. Keith, you say that investors should, quote, bring an umbrella for 2025. Explain what you mean by that.
Yeah, we think the last 2 years have been fantastic in the overall market. They're up, 2 years ago, it was up 25%. Last year, again, another 25%. So in aggregate, the markets have been up 60%. So while we're still favorable for the markets, we think it will get more of that normalized return of that 8 to 12%. We think you need to bring an umbrella. I think we're going to have some kind of corrections as we go throughout the year, a 5 to 10% pullback. Shouldn't be a surprise. So we're warning investors that they need to bring an umbrella, prepare for a little bit of rain. How do you do that? I mean, if you were a 60-40 client, a couple of years ago with the big run up in the stock market, now you're more like a 70-30 client. So what we want them to do is rebalance, get back to that 60-40 where your original plan was. Another way of doing it is we have some structured buffered portfolios that provide some downside protection, but also allow you to participate in the market on the upside. So that's what we mean by bringing an umbrella.
With that in mind, this has been an interesting week because, of course, we have more news coming out of DC and policy decisions that are rolling out. You also have more earnings reports. And then amidst all of this, you still have the NASDAQ and the S&P 500 still notching some new record highs. Of course, we're moving off of those levels today. But what does that tell you more broadly about how this market is weathering some of the larger kind of events that could prove volatile?
Yeah, it's pretty impressive with all the negative news that you just talked about that the markets haven't been selling off, especially, again, after we had these nice big run. The S&P, year to date, it's almost up 4%, even with all this news. But I think the market investors are looking through it. If you look at the earnings forecast for this year, expectations are for 14 to 15% EPS growth this year, followed by another 14 to 15% next year. We think that's a little too optimistic. We think it's more maybe like that 8 to 10%. But again, even with an 8 to 10%, that's a good backdrop for the stock market. I think that's what investors are looking at. They're looking at that earnings growth potential and unemployment rate's at 4%. So if consumers are working, they have money in their pockets, they're spending, I think that's going to continue driving the markets forward.
All right, what's driven the market so far and over the past 2 years has really been this Mag 7 trade. However, you're looking at 6 names specifically and taking one out of that basket, and that's Tesla. Why is that?
Yeah, Tesla, I think, is pure on valuation. It's a name we like. They're very innovative. Musk's got a lot going on right now, but it's a name we don't want to own here. We think valuation's too expensive. The EV market's coming under some competition. We haven't seen where batteries are going. Robo-taxis is still on the come, and I think that's what everybody's betting on. But that could end up getting pushed out to the right, so we want to wait for the stock to come in a little bit more before we get interested in it.
And so with that in mind, how are you kind of positioning for yourself right now, looking out into the back half of this year where we're going to be waiting for some of the interest rate decisions as well from the Fed?
Yeah, so we think the market can start broadening out the last 2 years. It's almost been driven, solely by the Magnificent Seven names just, running high. So we think, obviously, you still want to be involved with those names, but we don't own Tesla. We own the other 6. You want to still own them. Just probably maybe own a little less than your benchmark. And I think the market's going to continue to broaden out. You want to look at names like healthcare, some industrials, things like that.
You're also looking at Netflix, Dexcom, Palo Alto Networks, and a company that also just reported this week, Walmart. Just walk us through your kind of top pick thesis on these names.
Sure. We like leaders in the space. And the first one you mentioned, Netflix, they had a phenomenal quarter, big beat, had big numbers on their sub ads. So that's a name we continue to like. They're the leader in the streaming space. Everybody's chasing them. We think they can hold that premium multiple. And again, as ad revenue kind of builds on their new model, we think that's a good thing for them. You mentioned Palo Alto. They had a really good quarter. Again, they're a leader in the space. Everybody's looking for security. With all this new AI play, they're going to be the beneficiary there. Walmart's the one that disappointed those names that we just talked about. Again, they had a good quarter. Guidance was subpar. They took EPS down by about 8%. That's why the stock went down. Stock is not cheap. Now, we have to keep an eye and see if the consumer's actually getting a little bit pinched with some of the stuff like high interest rates. Are the consumers starting to put more on their credit card? that's something we have to continue to watch. But I think Walmart's taking share, so we still want to be involved with the name as well.
Keith, thanks so much for taking the time here.
Thank you.
Now time to dig into today's top trending ticker on Yahoo Finance. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. It's an active one. Let's take a look at UnitedHealth Group, responding to the Wall Street Journal report that claims the Justice Department is investigating the company's Medicare billing practices. UnitedHealth Group says the journal, quote, continues to report misinformation on the Medicare Advantage program, end quote. The healthcare company says that the government regularly reviews all Medicare Advantage plans for compliance, and they are not aware of the, quote, launch or of any new activity. UnitedHealth says any suggestion that their practices are fraudulent is outrageous and false. The journal's report claims the new civil fraud investigation is examining UnitedHealth's practices for recording diagnoses that trigger extra payments to its Medicare Advantage plans. Shares of UnitedHealth Group are falling on the day. Nvidia's fourth quarter earnings are on deck, but the results may not be as important as they've been in the past. Yahoo Finance's Julie Hyman is here now with a closer look at what they mean for the broader market. Hey, Julie.
Hey, Brad, thank you. Well, part of this is just because of the action that we have seen this year thus far, where the contribution of the Magnificent Seven, including Nvidia, has really fallen relative to the rest of the market. That's in part because of underperformance of those names and in part because of the broadening of the types of stocks that are doing better. This long-awaited broadening that a lot of investors have been calling for a while. So Yahoo Finance crunched the numbers. This is as of Wednesday's close, so we might have seen some tweaking since then. In terms of the biggest contributors to the rally this year in terms of the market cap gains. Now, last year, it was Nvidia unquestionably, and all of the others were members of the Magnificent Seven: Apple, Amazon, Meta, Alphabet. In terms of their size and the magnitude of the gains, they contributed the most to the S&P 500's gains. In fact, for the Magnificent Seven all together collectively contributed more than 50% of the gains for the S&P 500 last year. This year, it's a very different story. Yes, Meta's still number one at around 13%. Nvidia's at number two. We'll get to its percentage in a moment. But then you got Walmart at number three. You got JP Morgan Chase at number four. Eli Lilly is on the top 10 as well. So it is a more diverse, beyond big tech list of stocks that's doing well. For Nvidia specifically, last year it accounted for 20%, just Nvidia alone, of the gains in the S&P 500. This year it's a little more than 5%. So it's not that Nvidia is not important, it's just on a relative basis it's less important. Just another way to slice and dice this, to look at the broadening trend that we have seen, is to look at the S&P 500 year to date, which is market cap weighted. That is, companies like Nvidia and Apple have a bigger weighting, a bigger influence. And then if you equal weight it and look at the year to date, it's pretty much neck and neck. There was a big gap between these two last year. So just again, gives you an idea of the closing of that gap that we've seen. So that's part of it. And then part of it is also just that Nvidia is not wowing us quite to the same extent than it was when it first began wowing us as it was first catching fire with the demand for generative AI chips, right? So if you look at the company's revenue trajectory, really started taking off in 2023, and its reports then, and we were seeing triple-digit gains. The revenue gains, by the way, peaking right around 260% here. And that was, if you look at the quarter when that happened, that would have been its fourth quarter of 2024, fiscal fourth quarter of 2024. It's on a bit of a different calendar. Now, the estimate when it's coming out with its numbers next week is for revenue of $38.26 billion. That's still a 73% gain. It's all relative, right? It's still a 73% gain, which is a big gain. It's just not sort of the heady, huge triple-digit gains that we had seen from Nvidia in the past. And, you know, we did see Nvidia fall a couple of quarters ago when it reported. Last quarter, the stock was a little changed. So we'll see what kind of halo and ripple effect it has this time around. Again, it's not that Nvidia isn't important. It's just that it has become less important as we get this broadening. And then finally, just want to take a look at the stock action in Nvidia, if we could get it to come up. the stock action in Nvidia that we have seen year to date here. So here's Nvidia. The stock is up about 3.3% year to date here. Here's today's action. So it is higher year to date, but its record high was back on January 6th, and it has not reattained it since that date. So again, just something to put things in perspective as we await those earnings after the close next Wednesday, Brad.
I've got my kitchen timer set. It's on the max numbers that I can put it on for that countdown. Thanks so much, Julie. Nvidia is the second largest company in the world by market cap at $3.4 trillion. It was founded in 1993 by 3 people, including current CEO Jensen Huang. Since its IPO in 1999, shares have risen more than 300,000%, with much of the increase happening in the last 5 years. The company has led the AI boom on Wall Street. Jensen Huang has served as president, CEO, and a member of the board since the company's inception. Huang is currently the 13th richest person alive, according to Bloomberg's Billionaires Index. He has a net worth of $119 billion, trailing other big tech CEOs like Elon Musk, Mark Zuckerberg, and Jeff Bezos. The majority of Huang's wealth comes from his 3.4% stake in Nvidia. That shakes out to about 837 million shares worth around $117 billion. The other $2 billion of his net worth is in cash and other assets. In 2025 alone, Huang's net worth has grown by $5 billion. We will have special coverage of Nvidia's fourth quarter earnings report Wednesday, February 26th, starting at 4 p.m. Eastern Time on Yahoo Finance. Well, the IRS is reportedly laying off more than 6,000 workers, the latest cuts in the Trump administration's efforts to reduce federal bureaucracy. But the layoffs come at a critical time for the IRS, the 2025 tax season. Here with more on how cuts could impact your taxes and your refund is Tom Osabin, who is the Director of Tax Content at the National Association of Tax Professionals. Tom, good to have you here, and thanks for taking the time to help us break this down. What kinds of issues could we see with the IRS layoffs taking place at the beginning of this tax season?
Yeah, the timing is really ill-timed. Could easily say that as we're getting into the heart of the tax filing season now. So I'm likening it in some ways to back during COVID when people had to work from home or there were stay-at-home orders. And we gave similar advice then, and I'm going to give it now. I'm a tax professional, been one for more than 30 years. It's no different what I do that I would say to someone out there who's going to maybe work on their own return this weekend. And what you want to plan to do, this layoff situation could in fact be a non-event to a lot of individual taxpayers if they, number one, commit themselves to try to avoid person-to-person contact at the IRS. In today's tech-heavy world, just had a great discussion about all of the tech stocks and how they're doing. The notion being electronically filed, just as we're seeing here on the chart. So put your data together, and if any possibility, electronically file. But before you press send, be sure to review all that data and make sure it's accurate so it'll be in the system and processed like normal. Double check those social security numbers and the names. If you had a dependent perhaps that was born late in 2024, do you have a social security number yet for that child? When I meet a new client, the first thing I do is I look at last year's return. So even when you're sitting there doing your own return, start with last year and make sure you've got good data that you're putting in. Make every attempt to electronically file, either through commercially available software, your tax professional, the IRS free file program, and try to make sure that you've got good information going in. I would also suggest to set up for direct deposit. What do you need to do? Double check your bank routing number and account number before you press submit, because that'll be another way to avoid making sure we don't have to have person-to-person contact before everything goes awry. Now, one thing also to do to help to not clog the phone lines, use the IRS Where's My Refund tool, as opposed to calling the 800 number, which you're going to be very, very frustrated and you're going to be on hold for a long time. Use the Where's My Refund tool. Realize that even after you get a confirmation back from your software, it's going to take several days, if not more than a week, for that data to be available on the Where's My Refund tool.
Right.
So from that standpoint, patience is a virtue. And again, you're trying to avoid, I'm sorry, go ahead, but I was just going to say patience is a virtue. Be prepared for long waits if you're going to have to call.
And so is there any potential impact as a result of the layoffs to people's tax refunds?
So far, we haven't heard that. Most of the returns are processed in an automated fashion, so that's the good news. If for some reason a return is kicked out, I will tell you that long ago I was taught that a tax return is kind of like a health insurance claim. The difference is a health insurance claim is reviewed pending acceptance. IRS submissions of returns are accepted pending review. So the things that would cause a later review of a return don't happen in the electronic submission process. There's only a couple of ways that a return would fail. One being Social Security numbers and last names don't match. That will kick a return out of the system. If you happen to purchase your health insurance on the marketplace and you didn't enter the data from that Form 1095A, that will cause the return to immediately reject. So you want to make sure you've got that information, just as we showed in the slide a moment ago, as to having your data good, you have everything together, and you submit a clean return. Garbage in, garbage out is the old saying.
What if people have concerns about data breaches? What's your advice there?
That's always a concern. And, larger companies than mine have certainly been hacked and all of those issues. The IRS has the ability to get what's called an identity protection PIN. Now, in years past, you have to either be a victim of identity theft or feared you were, and in order to get one. Now anybody can. So if you've got the nuclear family, husband, wife, 2 children, you can each have an identity protection PIN. You go to the getanippin.com, which is part of the IRS website, and you can get that set up. That will provide another layer, almost like multi-factor authentication, another layer that the bad guys have to get through, and I always describe it as the keys to the candy store. If the bad guys can get a match to the first 4 letters of your last name and your social, they're in. But if they've got one more layer they've got to get through, that being that identity protection PIN, one more step to make your data more protected. One other thing I want to throw out to you as we're talking about the potential for data breaches, if people have anxiety right now, there are bad guys out there that prey on that anxiety. Don't bite on emails that you get that say, we'll help you. We'll help you get your return through. Listen, if it's unsolicited, it's going to be a problem and probably cause you more problems down the road.
Tom, thanks so much for taking the time here. Really appreciate it.
Thank you very much.
Coming up, ChatGPT versus Claude. And don't forget about Gemini. We're talking to an expert who tested all the major AI chatbots out there to tell us which one you should try next. A year ago, in March of 2024, Pew Research found just about a quarter of U.S. adults had used ChatGPT. By November of 2024, OpenAI CEO Sam Altman said the company was up to 300 million users per week. But OpenAI has competition. Google, Anthropic, and X all have their own generative AI chatbots. Sabrina Ortiz, ZDNet AI reporter, tested them all and joins me now in studio to break down what she found. Great to have you here with us in studio. So first, let's start with OpenAI, perhaps the chat daddy of them all, if you will. With this particular chatbot, what have you found, and ultimately, what's the takeaway?
Yeah, so like you said, OpenAI is dominating the space. It's the name that most people are familiar with. Most households, I think, they hear AI chatbots almost synonymous with ChatGPT, and that's for good reason. It is a very, very capable chatbot, and even in its free tier, it has robust offerings where anybody that's a casual user or just interested in experimenting with the chatbot could get a lot of really powerful tools. So it is still a chatbot dominating the market, and it is a great option.
Okay, and so what we've often talked about is the fact that these chatbots could replace search, and the name that is synonymous with search is Google, so much so that it's essentially a verb at this point. So they have their own chatbot, Google Gemini. What have you found there?
Yeah, so when Google first entered the space, it was a bit of a dark horse, right? It started with Google Bard, and Google Bard was a bit of a flop. It didn't quite meet those expectations, but then it quickly pivoted, it rebranded, and then it launched Gemini. Gemini is actually a very, very capable tool, and like you said, Google's synonymous with search engine. So they have a unique position in that when people are Googling, they will, I'm sure you're familiar, you make a search and you see an AI overview. That's powered by Gemini. So not only is it a capable tool, but it's also able to reach people really easily through products like Google Search, right, or in Samsung Galaxy phones, or on Google Pixel phones, or even tools like Google Meet, which a lot of people already have in their workflows. So not only is it a great chatbot, but it's also really easily accessible by people, which I think makes them a very, very competitive chatbot in the market.
Also proves that maybe getting the name right is key to this as well here, because we weren't buying Bard for a little bit, but Gemini, we can start to get around that a little bit more. Also, speaking of names, Claude, we got to talk about this one. This one's from Anthropic.
Yes. Also a really great option. And what makes them unique is that a lot of people, when they hear chatbots and they hear AI, they're hesitant. And because of security and privacy concerns, particularly because you're inputting your data, right? So if you are using it in your workflow, you might be using some sensitive business data. Or even if you're using it for your own personal documents, you might not want that information then used to further train the model. So what Anthropic did from the beginning is they said, we are not going to train our models on your input data. So this really helped build, trust of consumers. And I think that's where that appeal is. So you'll hear a lot of people are gravitating towards Claude, also a great option in terms of performance, but also that unique appeal is really what's drawing, I think, people, and its unique competitive edge there too.
Okay, got to hustle to my finish here. We got a few more, a couple. Grok 3 from Elon Musk's X. What do we know about this one?
Yeah, so Grok 3 actually just launched on Monday, and it's much more powerful than both of its predecessing models, and it is actually super, super competitive. Upon launch, usually what these companies do is that they release the benchmark results, comparing it to the other leading market models, and the benchmark results show that it's actually blowing competitors, including Google, including OpenAI, out of the water. And most interestingly to me is in the chatbot arena, which is this crowdsourced platform where everybody, like from the public, can chat with two different chatbots, not knowing the name to them, and then vote. Grok, an early version of Grok 3, was put on that chatbot arena, and people voted. It was under the codename Chocolate, not knowing. So it's not like, oh, there was a bias knowing it was, XAI or Grok or anything, and people were voting, and it actually went all the way up to the top of the leaderboards.
Wow.
So yeah, it is showing a lot of promise. I haven't gone hands on it myself because it just launched, but actually yesterday announced that it is rolling out to free users. So if free users want to try it out and see what the hype is about, they can.
Okay, all right. Lastly, before we let you go, we got to know, what was the prize-winning bot right now?
I know that this might seem a bit predictable, but I'm still going to give it to OpenAI's ChatGPT. Okay. Again, just because in that free tier, it has so many offerings that I think everybody could take advantage of. And also, it's developing so many models so quickly, and perhaps I think the quickest, and it's setting the pace for the rest of the market. So if you want to be ahead of the curve and on track with all the cutting edge technology, I think that's a great option.
Sabrina, thanks so much for taking the time here with us in the
studio. Thank you so much for having me.
Appreciate it. Coming up, everyone, why the traditionally robust spring selling season could be tough for home builders. Plus, do you have too much house? We're giving you tips for downsizing. That's coming up next. Typically, the spring marks an uptick in the number of homes sold across the U.S. According to the National Association of Realtors, an average of over 18,000 homes are sold per day between April and June. But this year's season could be a bit challenging for home builders. Here to tell us why, we've got our own Danny Romero. Danny, good to have you here in studio. What are some of the challenges that lie ahead this spring selling season?
Spring is the busiest time of year for the housing market. And, you know, the season usually starts right after the Super Bowl and runs through May and June. And so this is a time of year where homes are sold at top dollar. They're also sold quicker. But we're already seeing the challenges, specifically for the home builders. We're starting to see some of those cracks. For example, D.R. Horton, they just reported their earnings, and they reported a 1% drop in their net orders in their first fiscal quarter this year. And so to help boost some of these sales, D.R. Horton has actively been offering mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. But at the end of the day, that impacts their margins. And so another home builder this week, Toll Brothers, is feeling those challenges. They lowered their guidance for home deliveries. And so some Wall Street analysts have come forward and said, hey, the challenges go beyond just demand. And so the bigger headwind here is rising land prices and also a more competitive selling environment. So just to give you some context on how competitive it is out there when it comes to the inventory aspect, data from the National Association of Home Builders reports a 46% increase in the number of completed, ready to occupy new homes. So that means new homes make up 30% of the homes for sale. And just to top it all off, President Trump's tariffs could add more price pressures, not only to consumers, but also to the builders.
Yeah, we had the National Association of Home Builders CEO, Jim Tobin, on with us yesterday. He laid out a lot of what you just ran through there a moment ago in the dynamics that they're seeing in the market right now, too. We know you're going to continue to keep close tabs on this, Danny. Appreciate it. 43% of baby boomer homeowners say that they'll never sell their current homes, according to Redfin data. So for the other 57%, how do they downsize from the family home of their younger years as they approach retirement? Joining me now, we've got Kathy Casey, who is a residential brokerage realtor at Coldwell Banker. Great to have you here on the show with us. So let's talk about this a little bit. For those empty nesters who are trying to downsize just a little bit, where does the thought process begin?
So I think the thought process really begins in what do you want your golden years to look like? As you know, you may have heard the Surgeon General declare that loneliness is becoming an epidemic. And, so especially for seniors, if you're not working anymore, you may be missing your sense of purpose. So what do you want your senior years to look like? Are you moving towards family? Have you considered being into an active 55 plus community where you can be part of a community? If not that, then perhaps consider, somewhere where you worship, or somewhere where you can volunteer for worshiping, or some other activity where you can be involved and just feel like you have purpose in your life.
Yeah.
So that's where I would start as far as that. Then as far as the home itself, I would get your realtor involved early because the family homes tend to be a little dated for the market. So you want to know what you'll need to do to get it ready for market. You definitely want the Brady Bunch, effect going on market right now. Then, start with decluttering because when you've lived in your home a long time, then, you have more stuff than you ever imagined that you have. And it just takes longer to get ready. Last thing yeah.
No. And the last thing, I believe, in these tips for downsizing your home, what is that last consideration and the questions that you need to consider about where you live as you were running through?
So the questions you need to consider about where you live, you have to take in mind, you're going to be able to get out and exercise. All those things, are you going to be close to family? All those things are things that you definitely need to consider, as well as what the financial implications of them are going to be. Getting your realtor involved early, I think, is very helpful. You want to also make sure that you, because you're going to be getting rid of a lot of stuff, make sure that you find that you preserve the memories you want to, either digitally or some other form. And also, when you're getting your realtor involved, because even though your house may be up to date as far as fixtures and everything, but sometimes the furnishings are older and it'll make your house look dated. So you want to make sure you get that. Yeah.
What are your tips for retirement era housing as well, for those who are finally getting into retirement and want to make sure that they're taking the right considerations for the home?
Yeah, I think that really needs to be on an individual basis. For some people, if you're making if you've been in your house a long time, let's say it's almost paid for, so you've got a great big next day coming from the sale of your home. Does it make sense for you to buy something else? It may not. It may make more sense for you to get involved into a co-op or something like that. That's, going to be more economical and doesn't require a whole lot of maintenance. So I think you have to take it at the first come, first served basis and see what really makes sense for you in your particular situation.
Certainly. Are there areas that you're seeing be hotspots for retirees who are considering that downsizing?
Oh, always. Always the warm spots are always, the places where people want to go, Florida, California, always somewhere warm is always more inviting. Like today we're in Colorado and We had snow this morning, so a lot of times you don't want to deal with that as you're, aging, shoveling snow and all that. So that's always the hot spots for people in retirement.
Kathy, thanks so much for taking the time. Good to see you.
You too. Thank you.
Coming up, with inflation ticking higher in the past month, we're taking a look at one asset that you might want to consider. That's next. Inflation ticked higher last month, with the headline figure rising 0.5% from the prior month. Inflation is up 3% from the year prior. Investors may be wondering how they should account for inflation in their portfolios, and today we're going over one asset that could serve as a hedge to inflation, and that is Treasury inflation protected securities, known as TIPS. TIPS are a type of treasury bond indexed to an inflationary gauge to protect investors from a decline in the purchasing power of their money. Here with more and the fuller breakdown, we've got Jeff Johnson, Vanguard Head of Fixed Income Product. Jeff, please explain how TIPS work and when they're beneficial to someone's portfolio.
Well, hi, Brad. Thank you for having me on. Well, the first thing we got right is the name. They're Treasury inflation protected securities, typically known as TIPS, and not to be confused with the sort of tip that we're all increasingly asked for when we use our cards to pay for various purchases. TIPS are real interesting as an asset class for investors who are looking to hedge out inflation risk from their portfolios. And the way they work is roughly 10% of the Treasury securities that are issued by the U.S. Treasury have a link to inflation, where the principal value is adjusted for the rate of inflation over time, in addition to paying coupon rate and an interest income just like any other bond.
So what are the risks of investing in TIPS?
The risks of investing in TIPS are similar to the risks of investing in other types of bonds. TIPS are still a bond, which means that when interest rates go up, that means that TIPS prices can fall. And we've certainly seen that over periods of time historically. So for those investors who are looking to hedge out their inflation risk, they need to be mindful that TIPS prices can fluctuate. The main way that they can combat that, though, is by choosing the inflation-protected fund or ETF that best aligns to their risk tolerance or time horizon. Shorter-term TIPS strategies like the Vanguard VTIP ETF have much less expected price volatility than a longer-term strategy that might offer a higher yield, but that would be expected to come with a little bit more price volatility.
And you have 3 considerations for people out there who are watching for investing in TIPS prior to adding them to your portfolio. What are they?
Yeah, it's the question around how to think about TIPS really comes down, first of all, to time horizon. So an investor needs to think about, how long is their time horizon? If they're looking to hedge out an inflation risk that's coming in the next 2 or 3 years, they should probably think about a shorter term option. If they're thinking about saving for an extended period of time and a investment outcome that is 10 or more years out in the future, they can consider a longer term TIPS strategy. A second consideration for investors when it comes to TIPS is the expected inflation rate. So investors can actually look at this asset class and think about what kind of inflation do they expect. Today, the 10-year Treasury yield has a rate of around 4.5%, and the 10-year TIP has a yield of about 2%. That means that the market's expected inflation rate is about 2.5%. For investors who are worried about inflation being higher than that, TIPS actually could make a lot of sense for them in their portfolio. And the final consideration is TIPS act a lot like insurance. And just like we buy insurance in advance of worrying about some sort of adverse event that could affect our lives, TIPS work a lot the same way. And that means that it's really important to have TIPS in your portfolio strategically because when that inflation arrives, if you wait to buy TIPS until after inflation occurs, it's probably too late. So it really needs to be a strategic component of investors' portfolios based on how much of a risk factor they view inflation as in their portfolio.
Certainly. Is there kind of a rule of thumb return that you should be looking for on your TIPS investments?
Yeah, the way to think about the expected return on TIPS is that you start with a stated interest rate or coupon on the TIP security. So as I said today, a 10-year TIP has a yield of about 2%. Now, over time, if held to maturity, that bond should return 2% plus whatever the rate of inflation turns out to be over the course of the next 10 years. The market is pricing that in to be about 2.5% today. So for an investor who allocates to TIPS today for the long term, they might expect a 4.5% or so return against an environment where inflation has been about 2.5%, thus providing them with a return of about 2% over the rate of inflation. That is the whole idea of investing in TIPS.
Jeff, thanks so much for breaking this down. Appreciate it.
Anytime. Thank you.
According to Fidelity Investments, Americans have an average of over $100,000 saved in their retirement accounts. But is that really enough to thrive? Here to break down how much you should be aiming for is Ross Mack, financial expert and host of the Financial Freestyle. Ross, good to have you back here in studio. So how much should Americans be aiming to have saved at every age here?
Yeah, well, one, right? Retirement is going to creep up on us, right? That's the one thing we never want to think about, right?
I hope it comes faster.
Well, I don't know. Well, I would like to retire yesterday
yes.
at this point. But I think a general rule of thumb is by the time you get to 30, you want to have 1 times your salary saved. And then now when you get to 40, you want to have 3 times that. When you get to 50, you want to have 6 times that. When you get to 60, that will be 8 times. And then once you get to actual retirement age of 67, you would like to have 10 times your annual salary.
Okay, so if those numbers sound intimidating, how do you go about actually achieving it over time.
Yeah, at the end of the day, right, the best time to plant a tree was 20 years ago. The second best time is today, right? And so I think when it comes to actually saying, okay, I'm a little bit behind on my retirement planning, how can I actually get there? So one, increase your investments, right? Like at the end of the day, you want to at a minimum target, 15 to 20%. If you're already at 15, let's go to 20. And now you'd say, where am I actually investing, right? If it's in your 401k, make sure you're taking advantage of your employee match program. You want to get that free money to effectively double your return in that short time, right? And I think another thing is actually see what you're invested in. I think that's very important. The average person just says, I've had people tell me, I'll put money in my Roth IRA. Now what? Oh, well, it's just sitting there. It's not doing anything. So one, know what you're investing in. Alternatively, you could also look at what you're investing in your 401k because, the average person is probably using a target date fund, and that's kind of a general one-size-fits-all thing, and it, for the most part, doesn't work, right? And historically, I don't want to, talk down on it, but like historically, the returns aren't as good. And when you think about it, right, it makes sense to get a little conservative as you get closer to your retirement age. However, it might, bode well to actually take on slightly riskier investments, more just ETFs, growth ETFs, S&P 500, just to call it simple. And I think another thing is also alternative methods of some streams of income.
Absolutely. Ross, thanks so much. Appreciate it.
Oh, man.
For more great advice, you can listen to new episodes of Financial Freestyle Mondays at noon Eastern Time. Coming up, how to save money on childcare costs. We've got tips for parents next on Wealth. A programming note. On today's episode of Warrior Money, Patrick and Dan speak to the CEOs of Parlay Finance and Torch Warrior Wear. They share advice for entrepreneurs looking to raise capital and find customers.
I would almost argue you're never done.
No, you're never done.
And so like as you build more and learn more, your position or hypothesis becomes more advanced, but the new frontier of your limit becomes where your learning drives next. So I think there's a lot of power in making sure your company is designed to be really rigorous about learning what is real, not what you want to hear. I want to give a shout out again to our CTO, James Cho here. He's really disciplined about, there's a book called The Mom Test, the art of listening so that you drive learning and not that you reinforce biases that can potentially distract the trajectory of your business.
You can watch new episodes of Warrior Money every Friday, 12:30 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. A recent survey from Care.com shows that the average parent juggles 5 different loved ones and care arrangements between children, aging parents, and pets. And yet, 48% say they don't have enough help. And this leads to caregiving stress. 90% report losing sleep. 80% say they've cried. Hey, that's okay. 71% experiencing health issues. We got to rectify that. Parents attribute much of their stress to affording care. The survey says parents spend 40% of their household income on care costs, with 22% on child care alone. The latest CPI print shows tuition, other school fees, and child care prices are up 3.6% from last year. Our next guest has a specific ethos around this topic and helping parents, and that is time is money. Here with more, we've got Letitia Barr, who is the parenting and education expert at Brainly. Letitia, great to have you here on the program with us. Can you just explain your thinking around helping parents manage child care costs?
Sure, absolutely. Well, thank you for having me. And as a mom of 2 college students, I know when we think about childcare, it's not just at the youngest ages where we're considering childcare costs. Certainly when our kids are toddlers and preschoolers, our costs are different. But as our kids get into elementary, middle, and high school, those costs change in terms of what we want to provide to them in terms of giving them the best education possible. So when we think about childcare, one way parents of preschoolers might be able to save on childcare is doing things like coordinating with neighbors to share childcare responsibilities through a nanny share or sitter share. This helps reduce individual costs for after-school care and summer supervision, while ensuring that your child is in a familiar and trusted environment. But also as your kids are getting older, elementary school ages and older, and they're struggling with homework, they're working to understand concepts, we're thinking about things like tutoring. And tutoring can be a huge cost for families. And I live in the Washington, D.C. area where a lot of the recent administration changes have affected families in our area, and people are looking to cut back. And that includes things like private tutoring and things like, for our older kids in high school, SAT and AP prep. So one really great way that families can save on those costs is to search out free tools. And using free online tools, such as tools like Brainly, can be a great free way that parents can ensure that their kids are being academically successful at no cost. So Brainly is a free AI tool that provides for free their community answers and their test prep experience. It's all 100% free on Brainly.com.
Wow. Okay, so you sent over 3 tips based around this idea of time is money to help parents manage costs. What are they?
So time is money. First of all, use your network of parents, right? Everybody wants to have a date night. Everybody needs time for themselves. In those statistics that you showed earlier, stress can be huge for parents. So coordinate with families in your area to reduce the cost of childcare. Rotate those childcare duties so you get a break. And older children, be strategic about their time off work. So time is money in terms of helping our kids be academically successful. If your kids can access free tools like Brainly to complete homework before you get home, I know that eliminates a lot of the struggle around the dinner table and beyond that comes with helping kids with homework. So kids can independently access Brainly both on the web and through their free app. They can get 24/7 homework help, test prep help. It can help them manage their time. And that for you as a parent takes a lot of stress of helping your kids when you get home from work so you can enjoy that family time with your kids.
Letitia, I got to hustle to my finish here, so I got 45 seconds. But how are you seeing families and parents specifically navigate child schooling costs right now?
Child schooling costs can be tough. I know as a parent of 2 college students that is a huge cost. Costs are going up, and families who are being laid off and furloughed, that's a big challenge. So I encourage parents to be knowledgeable about free tools like Brainly in order to help their kids and to be academically successful if you're having to cut back costs.
Letitia, thanks so much for taking the time here with us. Appreciate it.
Thank you for having me.
Let's do a final check of the markets as we're taking a look at the major averages. We are down fractionally across the board. The Dow lower by about 0.9%. The S&P 500 down 0.6%. NASDAQ Composite down 0.8%. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor.
Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Time for Yahoo Finance's Market Minute. Stocks falling as weak economic data weighs on the broader market. UnitedHealth, the biggest dragger on the Dow so far today. CrowdStrike shares are edging to the downside today on reports that the SEC and the DOJ are investigating its $32 million deal with tech distributor Carasoft to provide cybersecurity tools for the IRS. CrowdStrike shares down nearly 3%. Hims & Hers is selling off after the FDA declared an end to the weight loss drug shortage. Shares of Novo Nordisk, the company behind Ozempic Wegovy, are popping on the news. Rivian shares pairing some of the earlier losses, the EV maker reporting softer than expected delivery guidance. CFRA analyst Garrett Nelson telling Yahoo Finance, quote, there's a real demand issue in the EV space. You're looking at losses of just about 3%. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below. Track the best and worst performing stocks of the session.